Right. Good morning, everybody. Welcome to the second day of this conference. The first paper is by James Costain and Anton Nakov, and Anton is going to present.
Thank you very much, and thanks to the organizers for having our paper on the program. This is joint work with James Costain at Banco de España, and it's work in progress, so any comments or suggestions would be very welcome. And this paper represents our personal views and not our institutions, our employers' views. So the title is Control Costs, Rational Inattention, and Retail Price Dynamics. And here it goes. There is a typical figure that you nowadays see in several papers of a supermarket price trajectory that looks like this. And what's puzzling about it is that it combines two elements. One is stickiness, in that it often revisits, the price often revisits the exact same nominal values, which we call price points. Okay, and you can see these here and here, for example. And at the same time, it exhibits a lot of volatility in that it frequently jumps between these price points. So these are these high frequency oscillations between the high price and the low price. And the question is, what causes this stickiness and volatility, or jumpiness, as we call it, and whether it matters for business cycles. Now, many papers have abstracted from these events by filtering the data and therefore removing these high frequency oscillations. But the question is whether these high frequency sales, as some people call them, matter for the transmission of monetary policy. And so there are several theories that try to explain sales and model retail pricing with sales. And these are typically theories of sticky plans with multiple price points. So the firm doesn't choose a single price, but it chooses a plan in which there are, say, a high price and a low price. And then it is, when it is optimizing, it can choose between this high and low price, but then occasionally it also changes the whole plan. So the high price and the low price. And here is several theories, and one of them is multiple menu costs, and that there is a larger menu cost to change the plan and a smaller one to jump between price points on the plan. So these are papers by Eichenbaum, for example, and Alvarez and Lippi. Then there is theories of stochastic price discrimination, where firms face heterogeneous price elasticities of demand, as in Variance seminal 1980 paper, or Guimarães and Sheedy, Quijo and Midrigan. And then there is theories of rational inattention, where there are information processing costs that cause randomization between discrete price points within a plan, as in papers by Matejka and Stevens. But the issue we have with these papers is that we don't find much evidence of changes between plans, and I'll be more specific in a moment. What we do find is that sticky price points are updated one at a time. Let us have a look at the picture again to clarify what I mean. Now, if price plans were updated, then you would expect both the high price and the low price to be changed simultaneously. So you would see that, for example, here you have a new high price, but instead of having the low price continue, you would have a new low price, let's say here, okay? And that would be a clear change in plan. Only by accident can you have a situation, with probability 0, where one of the prices remains the same. So this, the fact that these events are rare and more frequent are events where, as I said, one of the prices is updated, but the other remains the same, suggests that we need a somewhat different model to account for this stickiness and volatility that we see in the data. So the goal of the paper is to model these sticky and volatile prices that are updated, price points updated one at a time, and trace the macro implications of this type of pricing. And so what we do is we present evidence of sticky price points instead of sticky plans. Then we extend our control cost model of sticky prices. These are single sticky prices, if you want sales filter, to generate multiple sticky price points, as we have seen in the raw data. Then we extend results linking rational inattention with control costs. And this is related to work by Steiner, Stewart, and Matejka in 2017 in Econometrica, by defining a computable limited memory rational inattention framework, which approximates rational inattention. We show that this model generates sticky price points, as we have seen, and we then assess the importance of price discrimination versus costly information in this framework. And at a later point, which is work in progress, we are assessing the importance of this type of pricing for monetary transmission. So this is where we are now. So some related literature. In the interest of time, I will skip most of it, just to say that we're not the first to think about these high frequency pricing events and sales. As I said, most papers remove them from the microdata and study sticky prices excluding sales, but there are several papers that do account for sales events. And the two papers that are more closely related to our work are the one by Matejka and Stevens. And these are both in the rational inattention setup. And so let me zoom in to these two papers. So Stevens has a model of sticky plans where all prices on the plan change simultaneously, whereas, as I said, in the raw data, new price points are introduced one at a time. Also, her model has two different costs: a fixed cost to obtain full information every plan, plus the usual flow information cost, whereas we model everything with the same standard cost. Matejka has a paper where his choice set is the real line, so it doesn't specify whether the model is nominal or real. And if it's real, then it's real stickiness that he obtains, not nominal. And if it's nominal, then nominal payoffs must be stationary for his model to work, to get nominal stickiness. So what we do instead is we have that leaving the nominal price unchanged is one of the possible actions of the firm. And I'll be more precise in a minute. So the outline is, I'll present some microdata evidence to show the sticky price points are prevalent in the raw data. Then I'll go to the theory and show the equivalence of rational inattention and control costs plus optimal default distribution. Then I'll go to our model of sticky price points, show how a limited memory version of rational inattention is computable. And then I'll go over the findings, which are, to summarize, that stickiness of price points are caused by cost of information processing, and volatility across price points is driven mainly by customer heterogeneity. So these are the two takeaways from our study at this stage. Okay, so let me go to the data. So to look more closely at price trajectory, we define backward and forward windows for store I product J, as the backward window is the set of all prices observed from time t minus capital T to t minus 1. And F is the set of all prices observed from t plus 1 to t plus capital T. And for us, T will be 26 weeks. So we'll be looking 26 weeks back and 26 weeks forward. So overall 1 year. And okay, so we classify price changes, which is an event when the price is different from the one in the previous week, as transitory, recurrences, and introductions. A transitory price change is one which happens at a price such that this price was never seen in the backward window, nor will it be seen in the forward window. So these are very rare events. We conjecture that many of these are due to rounding of intra-week price changes, but there could be some transitory price changes which are due to experimentation by firms. But the fact is, these are prices which are never revisited. Then recurrences are prices that appear in the backward window. And introductions are prices that are not in the backward window, but will show up in the forward window. So these introductions of new prices. And then we further classify price introductions into 3 types, which we call type 1, type 2, and type 3. And these are as follows. Instead of showing you the algebra, I'll show you in pictures. So type 1 introductions are such that they are really introductions are of new prices when there are no recurrences. So these are typical of single price policies. These prices also have some non-negligible frequency in the data. And these are what the typical Calvo model would produce. Okay, this is a typical sticky price, okay, without sales. Type 2 introductions are the sticky plans. So this is what the existing literature has modeled. So when the price plan changes, so this is this red triangle here, both the high price and the low price change at around the same time, okay? In type 3 introductions are the sticky price points where when the plan changes, so here, for example, this is denoted by the red star, yeah, the high price changes, but the low price remains the same. And then the low price goes up, but the high price remains the same, and so on, okay? So is that clear how we categorize price introductions? Then let us look at the frequencies of these events across products in the IRI data set. And this is an example for one store in particular in Atlanta, but this is a very typical picture when looking at other stores and other geographical areas. So what we have here is a 3-dimensional histogram that shows each point on this simplex here shows the frequency of transitory price changes, recurrences, and introductions of new prices for a given product. And the height of the bar represents the number of products in each bin, okay? And so what you can see here is that many price changes are recurrences. So that means that these high frequency sales events are really prevalent in the data. And when you look at the introductions, that here this histogram shows the frequency of type 1, type 2, and type 3 introductions. You see that most introductions are actually type 3. So these are the sticky price points, and there are much fewer type 2 introductions or type 1 introductions. So this is some suggestive evidence to say that we need a model of price setting that can generate sticky price points, and that this is what we are after. But before I get to our model, let me briefly review some of the existing literature on rational inattention and how we extend it to our model. So just to remind you, there's these 2 types of models that have been converging with the paper by Steiner, Stewart, and Matejka. And one is the model of control costs. And the idea is that precise decisions are costly. And what I mean by that is that to make a decision is modeled as allocating probability over the set of feasible actions. Okay, and say this probability is pi of A. And control cost models are models of full information where precision is costly, and precision is measured by relative entropy, this D, known as divergence, Kullback-Leibler divergence, or relative entropy. And it measures the distance of the chosen distribution pi from some benchmark distribution known as predisposition, or it's in our case, it will be an exogenous distribution of actions that applies if no decision costs are paid. Okay, so if the firm, say, decides not to incur any decision costs, it will choose prices according to the distribution eta. Okay, but the more it deviates, the more it concentrates mass on a single point. Okay, the more concentrated the distribution pi is on a single point, the more this distance increases, and the more costly this decision will be. Now, if you expand the control cost problem, you will see how it implies weighted logits. In particular, here we write the maximum of the expected profits of the firm, expected value of the firm, minus where we have now substituted in the Kullback library divergence term. Kappa is a parameter that scales the entropy control cost, subject to the constraint that probabilities must sum to 1 and are non-negative. And the first order condition of this value with respect to the probability pi is given by this expression here, where with some rearrangement, one can show that it yields a weighted multinomial logit as in equation 3. And here U is just a static payoff, or it may be the continuation value of a dynamic problem. And eta is the default exogenous default distribution or predisposition of the firm. And so this equation basically says that the firm will choose actions or prices that that yield a higher value of the firm with a higher probability. And with a lower probability, will choose prices that deliver a lower value of the firm or are less profitable. Now, so this is how it looks graphically. So suppose that the benchmark distribution is uniform over some relevant range. Then if the firm chooses to pay 0 decision costs, then its prices will be chosen from this flat line, from this uniform distribution. The error-free choice will be to assign probability 1 on the optimal price. Okay, this will be this Dirac delta distribution here at with point mass at 0 distance from optimal price. And in the intermediate case, firms will be picking prices according to some logic distribution, as shown in the blue solid line. Now, an important thing to know is that the sequence of decisions is irrelevant in the dynamic problem. So you can choose the probability of adjustment and then choose the distribution over new prices, or you can choose the distribution over new prices and then choose the probability to adjust, or you can choose simultaneously. In all cases, you arrive at the same result. Now, what about the rational inattention model? It interprets decision costs in a more specific way as a cost of information. And so here, the cost is one of mutual information between the action and the state, theta. And notice that it's a special case. It's a special case of relative entropy, where the mutual information measures the deviation from independence. So the more independent are the prices from the fundamental, from the state, the more costly the less costly the decision is. In particular, if they're completely independent, then there is no mutual information. This becomes 0, is the log of 1, which is 0. And so that is a firm that picks that picks prices according to the default distribution, according to its predisposition. Sorry, I cannot change the slides. Now you can rewrite this rational inattention problem. Again, now subject to the condition that the total probability of the action can be written as the sum of the conditional times the marginal. And notice that the rational inattention problem is just an expectation across various control cost problems. So the optimal benchmark here is the unconditional action distribution, the pi of A, okay? And therefore the solution takes the following form, which is again a weighted logit, but with the twist that now the default distribution is determined endogenously, and it corresponds to the unconditional action distribution. So it is not an exogenous distribution anymore, but is chosen optimally. Okay, so this is this proposition by Matejka and McKay, which says that the rational attention problem is an expectation across control cost problems under an optimally chosen benchmark distribution. And therefore it is solved by a weighted multinomial logic with weights equal to the marginal probabilities of each action. And we will use this result to extend our model to the case of dynamic rational attention problem with short-term memory. So dynamic rational attention problem with memory of all previous actions is an expectation across control cost problems under an optimally chosen benchmark distribution at each possible information set. But since we're not able to measure this each possible information set, we're going to extend this to the case where memory is limited. So there is dynamic rational attention problem of with memory of actions in a backward window, okay, of tau periods. That we show that it represents an expectation across dynamic control cost problems under an optimally chosen benchmark distribution at each limited information set. So
you have 10 minutes.
Yeah, I have to hurry up. Okay. So one thing I have to mention is that, yeah, like I said, it's not feasible to infer, you know, all possible information sets from the data because we can't repeatedly observe each possible information set. So the exact rational attention model is hard to identify and even harder to compute, but it's simple to infer the weights on average. So what we do is we take this default distribution to represent the sample frequency of the actions. So these are the unconditional distribution of prices. And we therefore approximate the rational attention model based on these average weights. And this is easy to identify and is feasible to compute. So here we also specify the action space in a stationary way so that, for example, the event of a price change, which is common in the data set, could be inferred directly from the data, whereas if you have an event defined as in Matejka that the price must be equal to some real number, that may be rare in the data set and may vary a lot across product, store, and time period. So with that, let me skip that for interest of time. Let me go to our model. So our model looks like this schematically. So so the firm has an option to adjust, which is V of price P, productivity Z, and given past prices in the window B, B of T. And that's equal to the, with probability 1 minus lambda, it will continue its existing price, okay, and productivity. And with probability 1 lambda, it is going to move to this option to choose from the set of backward prices or not. And this set of backward, so will be here. So this set of backward prices is a set of prices in real terms of the nominal prices set in the backward window. Or with and then this will be set with probability 1 minus mu, and with probability mu, it will pick from the set of all possible actions, P. Okay, so that's a large finite set of real prices. And so this is the value of setting a new price. So this is the maximum of the firm value, okay, minus the decision cost. So every equation subtracts the decision costs. Okay, so these are these expressions, these Kullback library divergences. In the case of choosing the probability, then that's the difference from some underlying decision rate lambda bar. Here is the decision from distance from underlying rate mu bar. And finally, this is the value of producing at the same price. Okay, it's just the current profit plus the continuation value. And then we have to update these price points. Basically, this is a set of nominal prices converted in real terms. So we have to subtract inflation from each of these backward prices. And to solve this model, we use neural networks because we have multiple states, multiple microstates. And the known solution algorithms are not suitable for this kind of multidimensional problem where the entire distribution of firms on price and productivity is a state variable. And moreover, there are multiple microstates. So let me in the remaining 3 minutes briefly show you our results. So we simulate 4 versions of the model, with and without memory, and with and without variable demand elasticities. So this is the case with memory and with a constant elasticity of demand. And the red lines are 12 examples of marginal cost or productivity evolutions, which are exogenous in this model. And the blue lines are the prices that firms would choose in each case. And so what we observe is a lot of stickiness. Okay, you see that there's these spells of sticky prices, and also sometimes previous price points are repeated, as we had in our multiple sticky price points observation in the beginning. Okay, but what we don't have here is the volatility. We see that these price changes are not that big, and so we then go to the case where the elasticity of demand varies between 2 different values, a high elasticity and low elasticity. And so this is as in Guimarães and Sheedy. And so you have like 2 types of consumers which which face the firm. So these are bargain hunters and loyal customers, if you wish. And now you see that we have the fact that markups rise when marginal costs rise. And so we have a lot more volatility between these sticky price points, as we have seen in the data. And also there is frequent repetition of previous price points. So just to sum up, some summary statistics. I will not go through all of them, but just to highlight that decision costs with finite memory help explain stickiness. So these are frequent recurrences and frequent type 3 introductions. And heterogeneous demand, having elasticity at 2 different values, help explain the excess volatility. And these are different measures of short-term volatility that we have computed. And they all show that you need this heterogeneous demand to explain the excess volatility. So to sum up, we have a model that explains sticky price points. Decision costs are important for the intermittent nominal adjustment of prices. Finite memory helped explain the recurrence of previous nominal prices or the sticky price points, and price discrimination is needed to explain the excess short-term volatility. Computing these models is feasible using neural networks. We define, therefore, a short-term memory rational inattention model, which is an approximation to the standard full rational inattention model, and show that how it can be computed. Also, defining a realistic stationary action set make it possible to identify the model parameters. And it can be tested, the rational attention model can be tested jointly with a hypothesis about the nature of the action set. With an arbitrary action set, it does not necessarily generate nominal stickiness, but short-term memory rational attention on a realistic action set can explain the observed sticky price points behavior, including sales. Thank you very much. I'll stop sharing.
Alistair, go ahead.
Okay. Yeah, so first off, thanks to the organizers for giving me the chance to discuss this paper. It's a great read. I recommend it to all of you. I learned a lot from it. Very briefly, The paper is a contribution to the large literature on how firms set their prices. And we know that understanding that matters a lot if we want to understand the real effects of monetary policy or indeed any shock. So it's an important question. And Anton and James here make two contributions on the empirics and then on the theory. So empirically, they document that the vast majority of retail price changes involve a product returning to an old price that's already been used at some point in the recent past. And the second fact is that when a firm introduces a new price, they don't tend to change all of their prices that they used for that product. So most of the time, these firms are going to introduce a new price and then they'll return back to an old one before then going back to the new one again. It's like they're slotting in the new price into the old set of prices being used. And that's going to be really important because they argue it goes against this recent paper from Luminitis-Stevens, which has firms sporadically reevaluating their pricing plans. And Anton's mentioned some other papers that have similar kind of mechanisms in them. I'll come back to the Stevens paper in particular because that's an important comparison to this one. Right, the authors then turn to a model that can explain their empirical results. They use a model with rationally inattentive firms linked to the control cost models that Anton's been talking about. That's very similar to Stevens has a rational inattention model as well, though it's a bit different. Obviously, the authors here make some changes to hit their particular empirical findings. I think there are two key novelties to mention. The first one that I'll focus on a little bit more is that they structure the firm problem in such a way that they can directly calibrate the unconditional probabilities of keeping the nominal price fixed and of returning to a previously set price. And those are important moments that they observe in the data. The second, I think, important novelty is that they're going to combine rational inattention with heterogeneous demand elasticities, which gives firms a motive to do temporary sales as a form of price discrimination. And they find that both of those are important if you want to explain the data. And then I know that the intention is to use this model to analyze the effects of monetary policy, which hasn't been done yet, but I think will be really interesting. The contributions already are really nice. That's just going to be kind of an extra great thing to add to the end of this. I just have one substantive comment on each part of the paper. So let me start with the empirics. Right, so the empirical results really focus around a classification of price changes into transitory changes, recurrences to old prices, and introductions of new prices that go on to be used in at least one more future period. And they divide these introductions into three types. So if we never return to any of the prices seen beforehand and there are no other recurrences, then they call that a type 1 introduction. That's what you'd expect to see in a Calvo model or a menu cost model. Type 2 is where there's no overlap between the set of prices before and after the introduction, but there are recurrences. And so that you can think of being like a reevaluation of the set of prices that the firm is using, which you might call a reevaluation of their price plan. And in this case, as I've drawn it, we deviate from the newly set price just once and then go back to that low price. And then finally, a type 3 introduction is where we return at least once to a price seen before the introduction. So we're introducing a new price without changing the whole plan. Now in the data, the authors find that the majority of price changes are recurrences. So we're already rejecting these Calvo and menu cost models. Within introductions, they're going to find that the vast majority are these type 3s. Now the paper then argues that this high prevalence of type 3 introductions and the relative rarity of type 2 replanning events, we're going to argue that's strong evidence against models of sticky plans. But I just want to dig into that a little bit because I think there's some important nuance to that argument. So this is a typical picture from a sticky plan model. And we start out bouncing around between the same two prices. And so most price changes are recurrences, just like the data. And then at this point here, the firm adjusts that price plan and they choose two new prices to oscillate between. So the first of those new prices is a type 2 introduction. But the second one gets classed as a type 3 because this higher price is observed both before and after it. So a type 2 introduction heralds the start of a new plan, and the paper is perfectly clear about that. What I just want to highlight is that all subsequent introductions within that plan are type 3. And I think that's important because it makes it a little bit difficult to reject models of sticky plans just based on the relative frequencies of type 2 and 3 introductions. If sticky plans had 4 prices in them, then you'd get that 75% of introductions should be type 3, which is pretty close to the data. And that's not some crazy number of prices, that's the median number of prices per plan that Stevens has in her Nielsen scanner data. And so the fact that replanning events are relatively rare compared to type 3 introductions, I don't think by itself rules out sticky plans. And then to push this a little bit further, if you look at the relative frequency of type 2 introductions, they only account for 11% of total introductions in your data, but almost half of the products across the 2 stores have no type 2 introductions at all. Well, that means we can definitely reject sticky plans for those products, that's fine. But it also means that for the remaining products, type 2s have to be accounting for nearer 20% of all introductions. And so I think one response to these summary statistics might be that, well, sticky plans are actually pretty good as a description of how prices are formed for around half of the products in the sample. And again, that fits in with the Stevens paper. She concludes that 60% of products in her Nielsen data have that kind of behavior. Now, this is a super crude look at your data, and indeed it's a very basic look at the Stevens empirics as well. The point I'm trying to make is that I don't think it's trivial to reject sticky plans on the basis just of the summary statistics currently presented in the paper. And I think the paper would benefit from a more systematic comparison between your data and that kind of model. Now, for what it's worth, I suspect your conclusions actually completely go through. I tried to be a little bit more thorough and compute the proportions of each type that you'd expect from the Stevens calibrated model using some of her summary statistics, taking account differences in the frequency of price changes and so on. And I got that her model would predict around 1/3 of all introductions should be type 2. So that's obviously well above what you're seeing in your data. But that was still a pretty rough exercise back of the envelope. So I think you could do something more formal. I suspect you'd find exactly what you want to find to make this point, and it would really strengthen this part of the paper to have that in a slightly more systematic way. Right, onto the theory then. A common way to generate prices that repeatedly return to the same few levels in a model is to use rational inattention or control costs. Stevens does exactly that, Matejka you mentioned as well. Faced with information costs, the idea is that rationally inattentive firms simplify their problem by restricting themselves to a small set of prices. But this paper points out a problem with those models. The prices in that small consideration set have to be chosen optimally. And that means they're going to be influenced by the distribution of optimal prices that the firm would set if they had perfect information. And if there's trend inflation, that distribution of optimal prices will be drifting up. And so the prices in the firm's consideration set will drift up to match. And so that's why with trend inflation, these models predict sticky real prices, while in the data we see firms returning to the same nominal price again and again. But thankfully, the authors suggest a way to save the rational inattention pricing model from that problem. So what they do, and I was pleased to see Anton had a similar diagram to this one. What they do is they say, rather than having firms in the model choosing over all possible prices at once, let's split the firm problem into stages. So first, the firm has to decide if they want to maintain their old nominal price or to adjust. If they adjust, the next stage is to decide if they want to choose a nominal price from their memory that they've used in the recent past, or to select from any other price. And each one of these decisions is a rational inattention problem. And so the conditional choice probabilities, that's these lambdas and mu's, they're going to take the weighted logit formula that Anton had on his slides. And they're going to depend on the expected present values of each choice given the current state of the world. Now, the nice thing is that as long as we choose the weights in those logit formulae correctly, doing this split doesn't change anything. This is completely isomorphic to the standard rational inattention or control cost problem, where the firm's choosing from the full set of prices all in one go. Now, I think the really neat insight is to see that actually those optimal weights in the logit functions are the unconditional probabilities of choosing each branch of this tree. And we observe those in the data. We know what the unconditional probability of not changing your price is. We can measure that. And so rather than starting with some distribution of optimal prices and working out what the weights should be, we can just calibrate them to those objects in the data. The conditional probabilities will still depend on the realized state of the world. It's only the unconditionals that we're calibrating here. Now, I think this is really clever. It's also a really useful methodological contribution to show that this is possible and show how it works. But the thing I'd like to push the authors on a little bit is how we should interpret these calibrated weights, because I'm not sure it's quite as simple as calibrating a free parameter. So if you think about just a standard rational inattention problem, you'd start out with some distribution of shocks, Z, and a profit function over the price that you've chosen and the shock realization. You'd maximize expected profit, net of information costs. That would give you the conditional and unconditional probabilities of selecting each price. And those unconditional probabilities are also then the weights in the conditional choice probability rules, which the authors referred to as the benchmark probabilities. And from that, we can then back out the benchmark probability of not changing your nominal price. That was 1 minus lambda bar. And so 1 minus lambda bar is determined endogenously by the distribution of shocks and the profit function, which means it isn't a free parameter. If we're changing lambda bar in the calibration exercise, something else has to change in the model to allow for that. So I'd really like to understand, what precisely is it that's changing about the firm problem to get us to this calibration, and what's the economics behind that change to the firm problem. So one possibility that I sort of first arrived at is that we're moving away from full rationality. And this is where I felt some of the worded explanations in the paper were going. There was some argument that doing nothing and keeping the same nominal price is just qualitatively different from acting and choosing something new. And so it's like it's just easier to not adjust. Well, in that case, you just need to drop the requirement that the benchmark distribution is optimal. And so we're no longer fully rational. We don't have to have the unconditional probability equal to the benchmark. So in that case, you can set lambda bar to whatever you like. That's fine. It's still going to affect choice probabilities. So we've still got a link going in this direction. It's just that 1 minus lambda bar no longer has to equal the unconditional probability of doing nothing. But it was at this point I got myself a little bit tied up in knots, because I don't think that's quite what's going on in the maths. So the paper says pretty explicitly that 1 minus lambda bar is the unconditional probability of not adjusting your price, and it's calibrated accordingly. But that's only true if lambda bar has been chosen optimally. And so if we're still in the fully rational world, and therefore if this equality is still working. But if that link's still operational, well, the only way we can change lambda bar is by changing one of the inputs. But the shock distribution and the profit function both seem to be fixed. So I didn't really understand, given all of that, what choices are being made when we calibrate lambda bar. I'm sure it's just that I've missed something and that it's whichever one of these, I think that's fine, but I think I'd really appreciate some more discussion in the paper of precisely what it is that's changing when we do this calibration. Because it doesn't seem to be as innocuous as, say, calibrating a discount factor in an RBC model. And as well as just understanding the mechanism there, I think that's important for when you come to look at monetary policy. A big selling point of rational inattention is that choices are disciplined by equilibrium, just like in a standard full information rational expectations world. And so if lambda bar is chosen optimally, and the high probability of doing nothing comes from either the distribution of shocks or some utility benefit of not doing anything, well, then when policy comes along and moves the whole distribution of optimal prices, lambda bar we would expect to adjust. But if it's that we've broken the link from the inputs to the firm problem and the benchmark probabilities, then it wouldn't. Lambda bar would stay the same, potentially. Yeah. So I think the pricing behavior will be quite different in those scenarios, and I think it would be helpful to understand, which case are we in this model. Right, I think I'm probably over time, so I'll wrap up there. Yeah, I really like the paper. I think it makes important empirical and theoretical contributions. I just have these two substantive comments, and both of them are really just asking for a bit more explicit discussion of certain areas of the contribution. Right. Thanks.
Okay, thanks, Alistair. If you stop sharing your screen. Anton, you want to very briefly sort of respond to Alistair?
Yeah, thanks a lot, Alistair. This is a very thoughtful discussion, and thanks a lot for explaining our model so clearly and probably better than I did. Yeah, I honestly agree with your both comments. On the first one about empirics, it is true. We also noticed that this is a feature that type 2 the plans, will have the type 2 introduction followed by type 3 introductions. We are thinking of ways to more formally address this issue and to more formally compare ourselves to Stevens. We haven't done that yet, but yeah, we should think about this more closely. So again, thanks for showing the model and explaining what goes on. On your second point about the lambda bar, the way we have it now is lambda bar is exogenous and estimated from the data, calibrated to match the unconditioned frequency. And so if we were to substantially change the inflation environment, of course, the average frequency of adjustment would change, but the lambda bar as it is will not be updated in our model. We will have to re-estimate the model to do that. So we are, I suppose, in your first case where we break the link to lambda bar. James, correct me if I'm wrong, but I think at the moment this is how we have it. But we have to think more carefully about this problem as well. And thank you very much.
I guess I would say I also agree very much on your first point. We're aware that we have not quantitatively proved that we can reject Stevens' model. One way to do it is just to estimate her model, estimate our model, and run a horse race. But that's actually a really ugly parameter-dependent exercise. So it would be nicer to have some simple statistical argument about what's the ratio of type 2 to type 3 that you should observe. And unfortunately, we don't have a good argument on that yet. I'm not sure I completely understood your second point, but the fact is that it's a deep point that we're trying to bring out in the paper, and so it's not all that easy to respond to. But the way that I would answer it is that what we're trying to point out here is that rational inattention can be applied to many different types of choice sets. And we've tried to set up the model in such a way so that if the choice set were the one that Mateka says, that it's just the full rational line, then our model would, in that case, be exactly equivalent. And therefore, you ought to observe what his model predicts, which is that it's the real price that's sticky, and therefore the nominal price is continually trending, given the fact that the prices are not stationary in the data. Okay, so we think that that's actually an analytical rejection of his model, and we're saying rational inattention can be saved if you recognize that some types of actions are just not. They are not necessarily. They can be qualitatively different, and so if you say the action set is don't change versus set any other price, then that's something you can actually look at in the data using the average price adjustment frequencies as we showed. And once you do that, the model actually seems to work pretty well. So we're just saying that RI needs to be tested jointly with a hypothesis about what the action set is, unless you can create a deeper theory of what action sets are, and we're not offering that.
Let me try to broaden the discussion a little bit. There's a question by Sigal. Sigal, you want to ask it yourself? That may be nicer than me reading the question. Perhaps not. I'll go then. All right. So this is Sigal's question. So can you say something about the mapping between types of products, like elasticity of demand, and types of price adjustments? Could you do something about that empirically?
Well, so
yeah.
Anton, I mean, I think this is what we're extending towards now.
At the moment, yeah, we haven't done it. We always wanted to check this, whether we can categorize types of products and relate them to types of adjustments. We are working on that now. We have a co-author now on a follow-up paper working on that at the moment. We haven't done so yet, but it's an interesting question. I agree.
Yeah, we've pretty much just looked at, a couple of stores taken from American data, but now we have access to German data that we can classify by types of products, and we can separate across stores and so forth. So we're going to try to take a much deeper look at the stylized facts now with the German data. And that would include conditioning on type of product, for example.
Can I ask a really sort of big picture kind of question related to your introduction, where you said you were thinking about, thinking how this matters for business cycles and monetary policy?
Sure.
So suppose I have a model with a monetary policy shock. Mm-hmm. I know, how that's going to work if I have Calvo sticky prices.
Sure.
Why would the impact of a monetary policy shock be different if firms face your types of sticky plans prices?
Oh, because
it's something intuitive that you can tell it why this is going to matter.
Yeah, the model is state dependent. So in particular, the size of the shock will matter. The underlying inflation rate would matter for the transmission of the same shock, but also the prevalence of sales. So you could think of
the prevalence of price discrimination.
And the sales events. I mean, the fact that you have two prices, you're now more flexible. You can choose the higher price more often, and therefore the overall price level will be more flexible than a model without sales.
So the way to think, let me see what the interpretation is right. So the way to think about it is that if I have a monetary policy shock, mm-hmm. It's not going to be like a small change in the plan. The way you think about it, that's what's going to happen. I mean, so suppose indeed that we have the two prices very often. Mm-hmm. You think that the impact of a monetary policy shock is that more firms will sort of switch between these prices, and so that those would be.
You could do one of several things. You could either choose the high price more often. Say it's a positive monetary shock. You could stay more often at the higher price. You could also increase your higher price while you keep your lower price unchanged. Or you can increase both the high price and the low price. So these are different things you could do, and they would.
Okay, so I understand that that's a bit different at the micro level, but then if I aggregate,
if you aggregate, so the question is what happens with the aggregate with the flexibility of the aggregate price level, and we suspect that it will be higher. I suspect that it will be higher. Jim suspects that it will be lower. So we haven't done the exercise yet. So.
But it is an empirical question in the sense that whether or not price discrimination matters here. I mean, we think that what we've shown here is that the information frictions themselves are not what's driving sales. The model works to generate sales when you put in the heterogeneous demand, and that is something that makes prices strategic substitutes, which means that there's not a tendency to all do sales or all do higher prices at the same time. So insofar as the sales fluctuations are driven primarily by price discrimination, we don't expect that there's going to be a lot more stickiness from the model with sales.
But in the end, it's an empirical question. It's an empirical question. So we have to run the exercise of shocking this model with the monetary shock and then compare it to the Calvo model, like you said. And it could go in theory in either direction. And Jim and I differ in which direction it might go, but let's just...
So is there any chance that you could extend this model for a firm setting multiple prices, dealing with multiple products?
That would be hard. I mean, right now it's already a hard problem to solve, but I think it would be pretty hard at this point to do multiple products. I have to think about it.
Yeah, I'm not going to try to answer that yet.
But what is your hunch? Is that, are we really ignoring important stuff?
Well, it will depend then on, in addition, on synchronization of price adjustment across the products, no? And if you have a situation where these price adjustments are more synchronized, then you have more cow-esque behavior and vice versa. So the point is, there will be a whole new dimension to the pricing problem that will interact with what we already have. So it will be difficult to actually disentangle the two factors there, the multiplicity of the pricing of the prices on a plan and the multiplicity across products. So that's a whole new.
What if you take your model, and so the model would still be for individual products, but the lambdas and the mu's could be correlated.
The lambdas and the mu's.
No, I mean, the lambdas and the mu's are fixed parameters once you estimate the model.
But what I'm saying is that, so if you stick with the same price for one product, it's more likely that you stick with the same price for other products.
I see. Okay.
But other than that, you just ignore that these are products of the same firm.
Well, at the moment we have a single sector model, so we will need to extend it to a multiple sector model. And right now they are perfectly in line. No, all firms have the same lambdas and mu's bars. Yeah. So only when they're hit by shock, they start deviating in the frequencies of adjustment from different sets. But ex ante, they are identical.
Okay. Great. I think we're doing just a little bit over. Are there any other questions? All set? Excellent.
Thank you very much. Thanks a lot, Alistair. That was very nice discussion.
Yes, thank you.
Gives us something to think about.
Very good. All right. So the next paper will be presented by Luca Dodola from the ECB. Uh-oh. Luca was here a while ago. And we are on time.
Hello, can you hear me? Because, my connection is now becoming a bit
on, do I change my price or not? Do I increase or decrease my price? And if so, by how much? And they take that into account in their estimation of the cost pass-through to prices by modeling a first stage. The extensive margin of the first stage is a multinomial problem. Do I change my price or not? And do I increase or decrease my price, conditional on a set of observables, costs and other observables? And then there's a second stage that then estimates the cost pass-through. And because we are in a Heckman selection world, this cost pass-through can then take into account this first stage that we have estimated, basically that there's a certain probability to adjust the price or not. And if that makes my sample a selected one, this is taken into account in the so-called selection bias. So here's an illustration of how this works. And I borrow that from a menu cost model. So assume that we live in a menu cost model, then the world is described by a distribution of price gaps where firms are, the position of different firms in this price gap is given by their initial price and an idiosyncratic cost that they experience every period. And then based on where they are, they would adjust to an optimal price, which is given by the dotted line here. So that's the population, the data generating process in this world. So you can think of two firms now, one maybe starting at the optimal price, experiencing a cost shock, and then adjusting this price to the optimal price if the firm would decide to do so. And another firm that maybe starts far away from the optimal price and experiences the same cost shock and then adjusts to the optimal price. So obviously, the cost price pass-through is different for these two firms. They experience the same shock, but because they start with different initial prices, the price adjustment of one firm is larger than the other. So a true measure of the cost price pass-through in this population would correspond to a random draw from this distribution. So we take into account all of these firms. So think the average of these two firms, if you like. Where so the price decisions for the same cost are small versus large ones. But now, as is the case in the menu cost world, we have a friction such that the firms are divided into price adjusters and non-adjusters. So there's a menu cost that makes small price adjustments too costly. So these firms decide not to adjust the price. We have what is usually referred to in the menu cost literature, the so-called selection towards large price changes. So the price changes that are observed will only be those from, for example, this firm B, and I will not observe the cost price pass-through of this firm A had it chosen to adjust the price. So that means that if I do not measure these firms A in my cost pass-through equation, I may overestimate the pass-through of cost to prices because the price changes that I see are only large. Or if I assess a price change of 0 to these firms, which is the actual price change I observe, this may underestimate the cost price pass-through because I assign the wrong pass-through to these firms then compared to a situation where I would randomly pick from the distribution of firms. So this is how we should understand this. So what selection bias takes into account is that I do not randomly pick from this distribution. I do not observe firms that are randomly picked from the distribution, but rather only those that are selected towards the large price changes. Okay, so the key findings here, and so obviously I didn't write all of these on the slides because this is just a discussion. We can have some interesting results from the first stage where I estimate the extensive margin of price adjustment to cost shocks. And the authors find that the extensive margin of price adjustment moves after cost shocks when aggregate inflation, and also when aggregate inflation and exchange rates change. So this is obviously in line with state-dependent models of price setting, at least to some degree. So as long we need some endogenous response to shocks in the extensive margin of price setting, tells us that it may be a good way. A menu cost model may be a good way to think about the world, at least to some extent, or any other way to describe state-dependent pricing. Then the authors, since they have multi-product firms and uni-product firms in their sample, they do find that multi-product firms synchronize price adjustments. So the probability of changing a price depends on how many other prices in your firm are changed at the same time. So that's good news for menu cost models which have multi-product firms, and state that this price synchronization is key to pricing decisions, essentially, and the fact that this is important later on for the real effects of monetary policy in these menu cost models, whether they have multi-product firm decisions or not. So that's interesting news from this first stage estimation that we have. So that could stand alone by itself, if you like, but then it's used in the second stage to take into account the selection bias and the cost pass-through to prices. So the authors find that taking into account that selection bias is only of moderate importance, and they conclude from that time dependence matters for price setting. And they also find substantial heterogeneity in pass-through by a type of cost shock, by shock exposure, and by firm size. So that's the three main heterogeneity dimensions that we see here. So I have one figure from the paper that shows the results, and there are obviously many different results. So this is one, I think, where you see these last 2 points very well. So this is the pass-through of cost through prices from an energy cost shock and from an import cost shock. And the three different lines show you the difference of just estimating the cost pass-through with an OLS, including the pricing, the zero price decisions, or excluding the zero pricing decisions, and taking into account the selection bias, so correcting for that selection bias. So the first news here is that these three lines, I would say, are not like fundamentally very different from each other. So obviously the selection bias correction here matters to some degree, but not very much. And from that, as I just said, the authors conclude that time dependence matters a lot in the world that generated our data. And the other conclusion, or the other result that you see here as well in this graph, is obviously that the type of shock generates very different pass-throughs. So the energy cost shock pass-through is small to start with, 0, and then it builds up to all the way to 1 after, let's say, 1.5 years, whereas the import cost shock is passed through to a much lower degree. So it's a much lower level, but it's very persistent here. So it starts high and it stays that way. So that's something striking to see, I think. So, so this is where my comments start. So, so addressing, as I said, the paper addresses these two questions. What is the pass-through of cost to prices? And then, given that we estimate that, can we learn something about macroeconomic models? So let's stick to the first question for a second. So I think there's great data here, obviously, and very interesting results, for example, on the heterogeneity that I just showed. If you read the paper, there are many more results, for example, by firm size and by shock exposure that show a heterogeneity of the pass-through that's estimated here. So when reading the paper, I asked myself, why would we not stick to this first question and explore this more, understand more where this heterogeneity comes from? So I feel that there are many open questions that you could ask, you know, just from looking at the graph we just saw. So obviously what explains the differences in pass-through to different types of costs. So how should we think about that? What is the underlying input production structure maybe that drives this? And how does this relate to the very, very large by now empirical and theoretical literature on markups that's growing nowadays a lot? And people talk about competition, labor market, product market competition in driving these cost pass-throughs. And have we learned anything new here or something different? And can that explain the differences between large and small firms, for example? So that would be insightful to know. And then maybe one could take that one step further and use these results, especially this heterogeneity on the different cost types, cost shock types, and the asymmetry that we see in the pass-through to understand what the role of these different shocks is for aggregate inflation. And why do I think this is important? Well, if you look at the current discussion on how we move out of the COVID recession and whether there will be inflation or not, are there justified inflation fears or not? One of the narratives that you always hear is that import prices will matter a lot. Supply of certain critical goods will be restricted dramatically, such that, and some of these goods that are crucial for production are imported goods, especially for Denmark, and also think of raw materials that come from the outside. So some of these, the pass-through of these imported goods will matter a lot for whether aggregate inflation goes up in Denmark or not, or at least that's the narrative that's told, and maybe your results could give an answer to that to some degree. So I think that that would be a good question to address with the data that you have. And as you can see, this is just a discussion. This is obviously not addressed in the paper right now. Okay. The other question that we are obviously all interested in is then, when estimating this equation, can we learn something about the macroeconomic models? And there's two distinctions in this question. Well, one is, can we learn something about the macroeconomics of models of price setting with multi-product firms? And also here, sorry, I think you have great data and interesting results, which are really just the results are really just that there is price synchronization among multi-product firms, and this is as the models of multi-product firms, menu cost models with multi-product firms hypothesize, and then the paper stops here. But you could explore this almost completely as a separate second question, going all the way to use your results to inform menu cost models with multi-product firms. Since you directly estimate the price synchronization of the multi-product firms, and you obviously have a very good measure of the cost, you can see various moments of the cost distribution. You can measure autocorrelation of these cost shocks, which is a moment usually unknown in the calibration of these models. And it's a loose moment calibrated together with menu cost. Here we can discipline these models much more than we used to based on the results that we see. And maybe doing so would put a thumb down on, or put a foot down on the real effects of monetary policy in a quantitative way. So that's almost a separate paper, I would say. So that's, I think, where these results could be very useful. So the last, and then this is obviously difficult, and just having a discussion and not a presentation, is that, as I said, what is done here is, based on the Heckman model with the selection bias that's estimated, the authors conclude that since the selection bias is small, let me go back here because you haven't really seen this before. So it's not a big difference between taking into account the selection bias or not and estimating this pass-through. So the authors conclude from that that we can learn something about state versus time-dependent pricing. Basically, the simple takeaway here is, if the selection bias is small, time dependence is important in the underlying population, in the world that we're estimating. So I think if Heckman saw that output, he would just say, well, if selection bias is small, this just means that the non-linearity of the two-step decision is not crucial to estimate the unconditional expectation. But here you really take it one step, the authors take it one step ahead. So time-dependent pricing is not important. And where does this come from? Well, this conclusion relates to results on aggregate nominal demand. Actually, Nakov and Costain, I don't know whether they're still there, is cited here. So monetary policy shocks, it relates to results on aggregate cumulative prices in the literature, and it relates to results in the literature that have varying degrees of time and state dependence. So going through these in detail, I have my problems following that conclusion all the way through. So first of all, it relates to results on aggregate nominal demand shocks. So I think the paper would benefit from thinking about what these estimated cost shocks really mean in a corresponding model. So it's to me not ultimately clear whether this is really an idiosyncratic shock or an idiosyncratic variation of an aggregate shock. and how I would even model that for example, in the menu cost model. So do I have to think of a constant distribution and then just shocks that generate this distribution? Or is the distribution shifting? And then that's important for the results that we generate with these models, as I will show in a second if I have the time. So maybe I'm too lengthy. Wouter, you tell me if I have to speed up. And then the second question, obviously, is that, well, if you think about import costs, so these, for example, move with the exchange rate. So is this really just a cost shock? Obviously, it's a cost shock to firms, but isn't this also a demand shock? And if you think about Denmark, which is in a pact with the euro, isn't this even some indirect monetary policy shock that we look at here? So it's that, I think that it needs to be answered very clearly. What are these shocks that we're thinking about? So my suggestion would be to actually work this out in a model explicitly, which is not done at this point. So this conclusion also relates to, or it refers to results in the literature that have models with a varying degree of time and state dependence. So this suggests somehow that the world is driven by a combination of time and state dependent pricing, and a small selection bias tells us that state dependent pricing is not important. But I don't fully understand this result, because even if we live in a menu cost world, the menu cost model is the world we live in, selection bias can be small or large within this group of models, which has nothing to do with whether time dependence matters for price setting or not, and even for the same level of rigidity. And that's obviously because the selection bias depends on the shape of the price distribution, on whether we observe idiosyncratic or aggregate shocks, so that links to the comment before, or conditioning on initial prices. So going back to these little pictures that I have, obviously selection bias is large. The pricing decisions that we see are selected towards large prices. If these menu costs are such that, you know, lots of firms, so the distribution here is wide. So the shape of the distribution is such that the range here, pricing decisions that I do not see, is large. So if I assess a price change of 0 to a C firm, I obviously make a larger mistake than if I assess a price change of 0 to an A firm. So if I have lots of these firms, the selection bias is important. But I can have a menu cost model with a very narrow distribution. And there's many mechanisms that generate that, maybe multi-product firms. This is from my own paper with financial frictions, but that's not the most important point, right? It can be idiosyncratic cost shocks that have a certain shape. So there are many mechanisms that generate very narrow distribution with a high kurtosis. Then this area of non-adjustment is very small. And these C shocks that I saw previously are actually observed. So the selection bias is small in these models. But the world is still driven, well, this is my data generating process. The world is driven in a state dependent model. So how can I conclude from this that time dependence matters? So that's not ultimately clear to me. The other is that, you know, I think from what the paper says is they measure idiosyncratic shocks. So if I measure idiosyncratic, so a lot of the logic of selection relies on the fact that I have an aggregate nominal shock. Every firm gets the same shock. And then I have a selection towards large price changes compared to small price changes. But here I measure idiosyncratic shocks. So I do not rely on firms having the same size of a shock. I can have firms that have the same initial starting conditions at those firms that I do not observe, but firms that I do observe, but just have a very large shock. So these firms, as I kind of draw it, it's just the intuition, have the same relationship of cost to price change as those firms that I do not observe. So as soon as I have idiosyncratic shocks, by conditioning on initial prices, having good controls in my data, I will not necessarily estimate a very large sample selection bias. So it really matters on whether we have aggregate or idiosyncratic shocks here, I think. And if you have idiosyncratic shocks, maybe that's what makes this selection bias small. So the last point on the interpretation is, and so this is very hard now in the discussion because we didn't see the presentation. I was counting on Luca showing a rule of thumb decomposition, which he takes from Caballero and Engels, and maybe some of you know this, who divide price changes into extensive and intensive margin, or marginal and inframarginal firms. So maybe some of you remember that. And what the authors of this paper do is they take that and they equate that to a decomposition of time versus state-dependent pricing, and then conclude that everything, after taking into account the selection bias, maybe going back all the way to the equation here, the remaining cost pass-through that I estimate is in fact only driven by time-dependent pricing. And then so that I do not follow through all the way, because obviously, sorry, here's where I was, because obviously that is only true, you know, in a Calvo model, but not generally in a menu cost model or a state-dependent model, because the intensive margin can move substantially in response to shocks. So even if taking into account the extensive margin with a selection bias would leave me with just the intensive margin, I would see an enormous movement in response to shocks. And then also a Heckman selection model is not a proper decomposition of an extensive and intensive margin. So going back here, what I do take into account is that I do not observe certain firms that when estimating the cost pass-through to prices of the firms that I do see, I obviously do have these inframarginal firms, that's the marginal firms, that's firm B, and the inframarginal firms here in the estimate that I show. So obviously I have all the margins in my estimate, just controlling for the fact that I do not observe some of the firms that do not change prices. So I think there may be something to rethink here from that very last conclusions about state and time-dependent prices, and also here maybe it would be good to work that out explicitly. And then the last comment is just about the estimation. Maybe I leave that out because since we haven't really talked about that a lot, but it's more about that you can, you know, this two-stage process does not necessarily have to be estimated with Heckman. It could be estimated with Tobit. And there are some arguments of, you know, what makes Heckman weak is that you need exclusion restrictions that make the first stage pricing decision different from the second stage, which I think is not really backed by the theory that we know. But that's a small comment. Overall, I think it's a great paper and there's very rich data. So let me go back here. So very rich data, very interesting results. And maybe you should just work more on this one conclusion. But that will be very successful, I think.
Great, thanks a lot. I think everything is recorded, so Luca can listen to it later. I guess we can just talk among each other a little bit about the paper. But I have one question. So you have a paper yourself on micro price changes, but then in response to different shocks, monetary policy shocks, right?
Yeah.
And so how do your results compare? Because you also looked at intensive and extensive margin, I guess. Mm-hmm.
So in some sense, obviously, we find a large response of the extensive margin to aggregate nominal shocks. Monetary policy. So we estimate we take the monetary policy shock from Karadi and estimate that in German price data, and we see a large response to an extensive margin, which is very much in line with what the authors find here, just that they don't have these aggregate nominal shocks, but the cost shocks. Right. So extensive margins just endogenously move. So this is by itself obviously can be interpreted against any type of a Calvo model, I would say. So in that sense, it's very much in line. So in that part, also because I did it, but many other people did that too, is in that sense not news. It's a different type of shock. but that the extensive margin moves in response to shocks. That's not news. So what we obviously did when trying to, so we used our results to calibrate also the menu cost model then, different conditions, and finding out the adjustment along different margins, also learning something about selection, was exactly that we had to estimate the shock that is fed into these models, right? So you can obviously argue whether that's a monetary policy shock. The model is just a nominal demand shock. But in this paper here, what makes it more difficult is that it's really not clear, I think, what the type of shock is in this model, because there are these idiosyncratic cost shocks. But is this an aggregate cost shock, and is an aggregate cost shock the same as an aggregate nominal demand shock? It's not ultimately. I think it's intuitively clear, but it's not ultimately clear.
Right,
so it's easier in some sense. It's easier in some sense to link an estimate of a monetary policy cost shock to these selection questions than this one here. I would say.
So an exchange rate shock clearly is an aggregate shock, but these import cost shocks that they look at are, I mean, I guess they also could be due to exchange rates. But
yeah.
But so,
that's one of my comments. So in what is an exchange rate shock is not so clear. It could be an aggregate demand shock. It's for firms, it's a cost shock. It may even induce some monetary policy reaction implicitly somehow, right?
But so in their paper, did they, and if they didn't, could they distinguish between aggregate shocks and truly idiosyncratic cost shocks?
So that's not so clear to me, because it's a combination of this. So I think what they argue is they want an exogenous variation in the cost shock. So that's why they take the oil supply, and maybe they think exchange rate if you think import cost shocks. But then this will feed through as an actual cost shock to firms differently depending on their exposure. So they look at, think input-output tables. They look at the exposure to input, to energy inputs and imported goods. So every aggregate shock will be measured by the idiosyncratic cost outcome. So, and that's exactly the problem I have in interpreting these shocks and from the viewpoint of the model, right? So so I don't know. It's not the same size of the shock that every firm has. But in some sense, it originates in something aggregate changing. Does that answer the question?
No, okay, right. And then do you have any intuition why the response for the energy shock, although delayed, is so much bigger?
That I don't. There's not much explanation. It's this heterogeneity is really discussed at the very end, because they focus the paper on the time and state dependence. And I don't know exactly why.
Because it's kind of, intriguing, because the pass-through for an energy shock was almost 1, right? And then,
initially it's 0.
Initially 0.
And then it goes all the way up to 1. So it's very intriguing. I completely agree. And it would be good to have a good explanation for that. But for that, it would be good to have Luca here, because I didn't focus on that aspect too much. There's not a very detailed explanation, definitely.
So what I'm a little bit worried about, and I can ask you that question too, because you've written papers like this too. So it's great we're going to look at all this micro evidence, but it's hard, right? But you get all these bits of information, and it's a bit overwhelming. And so if you're like me, if you just want to build, a business cycle model looking at monetary transmission mechanism, I don't know what to do anymore. I don't know whether I have to do rational inattention or something else, and state dependent, time dependence. Is that we get so much information thrown at us. What do you think? Is that
so? You're basically asking, since I cannot put every data on every elasticity and everry little moment in, I would rather choose not to put in any at all.
No, I know, but there's so much information, of course, it's useful, but it makes it much harder sort of to choose. No. It was so easy when we only had Calvo pricing, and then everybody did that. But now we got, we got this interesting pass-through for energy shocks, which starts at 0 and then moves up all the way to 1. And then for import shocks, it is much lower. And then with monetary policy shocks, it's again somewhat different. And then it makes it difficult to write down a model because it's always very wrong.
But I guess then isn't the answer that we simply can't write down a model of the world that explains everything and has every little data detail in, but we should focus, which part of my comment was, I think. So because if we want to understand the difference in pass-through for different inputs, right, which are here, for example, imported goods and energy, I think we need to go into detail in one particular aspect, and that's probably maybe the production structure or whatever it is that we need to know, but less maybe whether it's state or time-dependent pricing, right?
Oh, that's interesting.
Isn't it? So, I don't know, maybe that's why how I was taught that, if I have a particular question, then I zoom in there. But maybe I don't have to think about it. But maybe you don't agree. Maybe we want to solve all the problems at the same time.
No, I don't. I don't want to solve all problems at the same time. But I was still sort of brought up in a way is that models should remain small enough so they're understandable.
Yeah. And
so what I'm a little bit worried about now is that because of all the micro evidence, which is sort of pointing at different directions, it seems that we may have no choice but to also write down really complex models. And maybe that's the answer.
I think I see Luca.
But maybe for the pass-through, it doesn't matter whether I have Calvo or state-dependent pricing, right? If the selection bias is small, and then it's just about how much of the cost is passed through, maybe for that, it really doesn't matter then to distinguish this particular fact. As opposed to understanding why some of the costs are passed through, when and by how much, right?
It'd be nice to show them.
Luca?
Yeah, I think Luca's has gone, I think.
He's back here.
Water.
Hello?
I might actually have some of it in my paper later.
Oh,
So we had
to
stay on.
Is Luca back?
No.
No.
Okay.
Alrighty. Anybody else?
Hello, can you hear me? Because
now we can hear you.
hello?
Yes.
Yeah, I think we've tried that.
Yeah. Okay.
Anybody? I mean, I probably tied everybody else with my frustrations about.
It's I told the discussion with being able to see it at all. Yeah, you can hear me. I didn't see anything of the. You've tried, come on, but then am I supposed to say what? I don't know what Anmut said. I have no clue what she said.
It's great.
There wasn't. There was not even a number that after three times with the conference, there was just a link and not even the number I could call with my phone. And then, she says something, I have no idea what she said. So, I don't know.
Luca, we're very sorry for that. I'll get in touch with you.
Can you hear me now? I don't even know.
We hear you very bad. I'll get in touch with you on the phone when the session ends and we can.
Yeah, but support sent me.
Now.
Yeah, okay. Well.
All right. I think we're just going to have a break now, and then we continue as planned at 1:30. Sorry, Luca. I mean, the connection is still bad, even right now.
Hello, everyone. I'm happy to open our actually last session before the governors panel, this afternoon session of our conference. Before we go on with our program, I'd like to give Luca De Dola a chance to say a few words. Unfortunately, we were unable to connect with him during the previous session, so we would like to give him a chance to say a few words. So please, Luca.
Thank you very much, Sigal, for this opportunity. I would like first to apologize because unfortunately my connection wasn't working. I need to go through the ECB systems. That was something that wasn't really allowing me to connect. But I also would like, unfortunately, there was no backup option that was provided. So I tried also to say my phone number, but I wasn't called. And I could not really follow also what Almut said. I thank her, for reading our paper, but I would just think, I was told this, I mean, perhaps, I can, going to say something that is not exactly correct about Almut's comments, but I would like to clarify a few things. The first one, I think, is that in our findings, we clearly say that we find support for hybrid models, not purely time-dependent models. And this is clearly so because we estimate in our first step, when we estimate the probability of a change in prices and how this is affected by shocks, we do find that this probability is affected by shocks. What we find is that, this state dependence has a small bearing on the transmission of the shocks we look at. And also here, I would like to clarify something about, the selection bias. It's important to notice that it is true that we use theoretical models in which the selection bias is present because due to aggregate shocks. But in a regression framework, the same bias will be present anytime you try to estimate through a panel a coefficient for a shock whose the coefficient that is common across all the firms, even though the shock is specific to the firm. And again, the reason is that you're really looking at cross-sectional averages that are distorted by this unobserved shock. So the selection bias is present for the econometrician that is trying to estimate any shocks. And by the way, this is also clear in other paper, for example, in a paper by Berger and Wavre in the JP. Then I wanted to clarify another thing, which is, our shocks identification. So we identify an oil shock, which is exogenous, and we make it firm level interacting with the share of energy at a firm level. But we also identify an idiosyncratic firm level shock looking at import prices that are specific only to the firm, that are derived from the same survey from which we collect our producer prices. And this can really be confused with an exchange rate shock because we do control for the aggregate exchange rate shock in our setup. So our import cost shock is truly idiosyncratic to the firm, we believe. It is also orthogonal to a bunch of other firm level controls, firm cost controls that we put. For example, we can control for wages at the level of the firm. So we think, we're really controlling for a lot of shocks and we're really identifying an idiosyncratic shock. And this brings me to the final point that I wanted to make, the interpretation of the heterogeneity. We spend the last part of the paper really trying to understand why the response to the shocks is different. And we attribute it to heterogeneity that is due to the difference in the shocks, how sectors respond differently to the shocks, and how firms respond differently to the shocks. And indeed, in all our paper, we emphasize that a lot of the action is really taking place through what we call the intensive margin. And by the way, this intensive margin is the same as in the Cavaliero angle decomposition. So we're actually attributing everything else that is really related to the selection corrected to the state dependence. So in some sense, we're really giving a lot of weight, the largest weight we can to the state dependence in the input response. But let me finally and with our findings on the heterogeneity. So we find that there is heterogeneity across the shocks because the energy shock, even though as a firm-specific component, is also a correlation across firms. And this means that there is an effect that goes through the competitors' prices. So we show that, once we control for competitors' prices, also, the impulse response is not just an impact, but also for all the other horizons of the impulse response. Then now the response of the oil shock becomes very similar to the response of the import shock. And this is in the paper. Then, and so, we find that there are indeed, general equilibrium effects in the propagation of the oil shock. Then we also break down, we want to find where the general equilibrium effects are originating. So we break down sectors between those that have a high direct and indirect exposure to oil and those that have a low direct and indirect exposure. For this, we use input-output tables for the Danish economy. And there we find that most of the delayed response that we see when we just pull across all firms is really due to the fact that firms in the low total exposure to oil react very late. So this is really evidence of real rigidities through general equilibrium effects that are coming through the pipeline. And finally, we also find, coming out to the import cost shock, that most of the smaller adjustment for the import cost shock that we find when we aggregate across firm is really due to the fact that larger firms are reacting less. So this is evidence of strategic complementarities at the firm level. So we do not claim that time-dependent models explain the data well, because they cannot really explain the state dependence we find when we estimate the logit first step, the probability of changing prices. We do address the heterogeneity in the responses of reset prices, the prices that adjust to the shock. So thank you very much for allowing me to clarify a few things that perhaps were missed in the discussion.
Thank you very much, Luca, for your comments and clarifications. Now we can move to our first paper, Time Varying Price Flexibility and Inflation Dynamics. Ivan Petrella will present. So the floor is yours, please.
Hello. So thanks a lot, first of all, for including our paper in the conference. So the paper is on time varying price flexibility and inflation dynamics, and is co-authored with Emiliano Santoro and Lasse Della Porte Simonsen. Now, before I get to the details of the paper, let me try to give you an introduction and motivation for what we do. Now, understanding to what extent prices are sticky and what gives rise to this stickiness is obviously something that is important. I don't need to perhaps motivate that much with the audience of this conference. It will affect the way shocks are transmitted to the economy. It will have implication for the dynamics of inflation and ultimately for the transmission of a monetary policy to inflation. So it's no surprise there have been a large number of papers that have looked at the micro price data to learn about the price flexibility. Yet, when we started to work on this, we found that there was much less emphasis on the possibility that price flexibility is actually varying over time, on what drives this time variation, and whether the time variation in the flexibility is something that is important for our understanding of inflation dynamics. So whether this is something that central banks or macroeconomists more generally should care about. Now, this paper is an empirical paper. We're tracking the evolution of the distribution of price changes for the last 20 years, looking at a sample of UK data. And we're looking at this data through the lens of a generalized SS setting model. This is a model that is flexible enough to allow for both time dependence and state dependence in price setting, and allows for time variation. We're going to find evidence for variation in price flexibility, and we highlight that this time variation is something that is important it generates non-linearities in the inflation dynamics. Let me give you an overview of the three main takeaways from our work. Now, looking at the stylized fact, we document that in the periods after the Great Recession, so the second half of our sample, we show that there is an increase in the dispersion of price changes. And at the same time, there is a fall in the frequency of price adjustment. We show that these diverging trends in dispersion and the frequency of price adjustment, they're consistent with the increase of the inaction to nominal shocks to price sectors. And this increase in inaction can itself be due to a change in the incentives and costs that firms face when they're deciding whether or not to adjust their prices. We document a large time variation in the aggregate price flexibility, and we show that a large part of this time variation is associated with the extensive margin and state-dependent pricing. And this extensive margin contributes a lot to the volatility of inflation that we've seen over the last 10-20 years. We also document the non-linearities in the dynamic of inflation. So in particular, inflation is characterized by high frequency, high volatility, and low persistence when there is high price flexibility, whereas inflation is characterized by more persistence, and so slow mean reversion, when we're in periods of low flexibility. Now, you may think that this last result is kind of obvious in a way. And if you think that, you would be surprised to know that this sort of non-linearities do not seem to be fully accounted, fully reflected in the way both the Bank of England and the market participants form their expectation about future inflation. Now, we'll not have enough time, obviously, to do justice to the large literature we connect to, but let me just say that we are obviously connected to the many papers which have been looking at microprice level data to document the presence of price stickiness, and we pose particular emphasis on the time variation of that. And we're also related to a number of papers which have looked at the UK data in particular, and there's been already like a paper discussed in this conference yesterday. Now, before moving to the results, let me say something about the data. We're looking at the micro price data that underpins the UK CPI. So this is a sample of monthly prices, and it's roughly covering 60% of all prices that are included within the CPI. We're excluding sales, so we're focusing on the regular price changes, but we're not interested in prices per se, right? We want to know about changes in prices, so we link the prices in our sample and build price trajectories. And when we do that, we break the trajectory every time that there is a product substitution, because that reflects the fact that we're looking at effectively a different good or service. And all prices are appropriately weighted following the standard CPI aggregation. Let me move quickly to some basic data facts. What I'm plotting here in red is the year-on-year CPI inflation for the UK over the sample. And on the left, I'm showing you the frequency of price adjustment. And on the right, I have the average price change for those goods or services for which we do observe a change in price. You can see from the right that obviously the average price change moves quite strongly with inflation. And on the left, you see that the frequency, right, it's low, as has been documented by other paper, but it's far from being stable over the entire sample. There is variation over time. So in particular, at its peak, right, which is roughly towards the end of the Great Recession, is twice as large as its minimum point, which we observe at the end of 2015. And in fact, we observe a downward trend, which goes together with the fall in inflation in the second part of the sample. Now, this relatively large variation in the frequency of price adjustments are something that have been documented before for countries which have experienced high inflations. And we were surprised to find them in the UK, where inflation has in fact been rather stable over the sample. We then move to a classic decomposition of inflation. So how important is the variation in the frequency as opposed to the variation in the average price changes? How much of these two components contribute to the overall inflation variability? The part that you would get, sort of like from a standard like time-dependent Calvo type price setting with a fixed frequency of adjusting prices, it roughly contributes to 50% of the variability of inflation. And the other half is actually attributed to the variation in the frequency itself, which becomes even more important in the second part of the sample. Let me say something also about the asymmetries. So on the left-hand side here, I'm decomposing the frequency between positive and negatives. You see that price increases are more frequent than price cuts. But for both, I mean, the positive and negative change in prices, we observe a fall in the frequency. And towards the last part of the sample, you do see that essentially price cuts are very, very rare within the sample. If you're looking then at the size of the price change, when the price change does happen, we do observe that there's been like an increase in the size of the price changes in the second part of the sample, and in particular, if one looks at price cuts. So price cuts have become much more rare, but when they do happen, they tend to actually be quite big. Now, having seen that, you should not be surprised to find that there has been an increase in the cross-sectional dispersion of price changes. So the price changes that we do observe, right, when they're different than zero, right, they tend to be large, right, both on the positive and the negative side, but most importantly on the negative side. So there are these diverging trends in the dispersion and the frequency of price adjustment. But if one puts aside the trends and focuses on the cyclical properties of these statistics, you also, in this case, you do find that there is a negative co-movement between the dispersion and the frequency of price adjustment. So in particular, in recession, prices tend to be adjusted more frequently, right? And there is less dispersion in the price changes, which basically means that you'll observe also many small price changes. Now, how do we reconcile these stylized facts? In the paper, we show that these facts are potentially consistent with shifts in the cost or incentives that firms face when they're deciding whether or not to adjust prices. And in fact, they will be consistent with an increase in market power or markup at the firm level. And this is something that is interesting because, in fact, I mean, Deloc and Ekun, when they're looking at the UK data, they show that there's been like an upward trend in market power that starts really with the Great Recession. And also we emphasize that this trend, right, there would be associated then with a fall in the aggregate price flexibility and with the increased importance of the extensive margin of adjustment over the last decade. In order to substantiate this claim, what we do, we take off the shelf the generalized SSS setting of Cavalier and Engel. This is an accounting framework to essentially characterize the variability of prices at the macro level. It is flexible enough to be consistent with both time dependence and state dependence in price setting and a combination of the two. Essentially, what this setting assumes is that at each point in time, there is essentially an hidden price gap, which reflects the deviation of today's prices from its optimal value. And this gap reflects the presence of cumulated aggregate or idiosyncratic shocks that have hit the firm since the last time prices were adjusted. And firms are facing cost of adjusting their prices, which essentially gives rise to an hazard probability. So you have an hazard function that essentially describes how likely it is that you're going to observe a price change for any given price gap. And an aggregate inflation is nothing more than a weighted average of all price gap, where you're taking into account that there is essentially a different probability of observing a price change for a given price gap. So if one has if one is able to characterize the hazard function and the distribution of the price change, then you're able to essentially say how important is state dependent or time dependence in price setting, and you're able to characterize fully the flexibility in prices. So in order to do that, what we do is to assume a parametric function for the distribution of the price gap, and we're assuming that they need to be within the family of the asymmetric power distribution, right? So this distribution here, it nests the Gaussian, the Laplace, and the uniform distribution, and it allows for asymmetry. And we assume that the hazard function is an asymmetric quadratic function. Now, the qualitative results that I'm presenting today do not really depend on these assumptions. We've done some robustness around that. Now, in order to get the exact value of these two functions, so we're going to estimate the values of the parametric form of these two functions using simulated method of moments, where we're matching a number of cross-sectional moments periods by periods, right? So this is essentially giving us a period by periods overview of the price gap distribution and the associated hazard function, given what we observe on price changes. So here is what we're getting. On the left side, I'm plotting a fan chart of the distribution of the price gap. You can see here that the distribution is far from being constant. It's typically, it has a location that is negative, which would be consistent with the fact that you, on average, observe positive price changes. It tends to be left skewed, and it increases. We also observe an increase in the dispersion in the second part of the sample. On the right-hand side here, I'm plotting the hazard function. So here, when you see like a darker blue, right, it means that price changes become less likely, and you see essentially like a deepening dark blue right in the last 10 years of the sample. Now, what does that mean? Well, another way of looking at it is to calculate the implicit inaction region associated with this estimate of the hazard function. So we defined an inaction region as a region of the price gap for which price changes are quite unlikely to be observed. And how unlikely they are, they're given by different thresholds. Here we're looking at 5 and 7% cutoff. And you see that there's been like a widening of the inaction region over the last 10 years. So that, for instance, at the beginning of 2016, well, price cuts that, price cuts which were smaller than 10% were quite unlikely to actually happen. Now, whether this inaction region, how important is this widening of the inaction region, it also depends on the variation in the distribution of the price gap, right? It can be that the price gap is itself becoming dispersed, so that not many price gap fall within this inaction region. So here we're looking on the right-hand side at the share of prices within the inaction region, right? And you do see that indeed, I mean, quite a lot of prices happen to be within the inaction region towards the end of the sample. And there is indeed quite a lot of time variation, no, on the number of prices that are within the inaction region, which sort of indicates the presence of time variation in price flexibility. But we can do better than that, because within the Cavalier and Engel framework, we can derive an aggregate measure of price flexibility, which is essentially equal to the variation in inflation at the aggregate level, which is associated to a marginal shift in the price gap distribution. And in fact, this aggregate price flexibility can be very handily decomposed into the intensive margin, right? So the average frequency of price adjustment, and the extensive margin, which essentially measures the selection effect, the fact that the shift in the price gap distribution itself, I mean, either makes more firm changing prices or makes some firms, I mean, delay their plans of changing prices or not. So here's a plot of the flexibility of prices at the aggregate level. And you see here that there is quite a lot of time variation. Right after the recession, prices were twice as flexible as what we observed, say, at the beginning of 2016 or around 2005. Now, before I dig into the decomposition of this flexibility, let me try to reassure you that what we're measuring here is genuine. So obviously, the Cavalier and Engel is not the only measure of flexibility that is available out there. And in particular, Alvarez et al. Have put forward a sufficient statistic for money neutrality, which maps to a accumulated output response to a monetary shock within a sticky price model. And they show that this is actually proportional to the ratio of the kurtosis of price changers over the frequency of price change. And if one measures the kurtosis at each point in time, right, then you can derive also a time-varying measure of money neutrality using their approach. So on the left here, right, I'm scattering like the Alvarez et al. Sufficient statistic against Cavalier and Engel price flexibility. And you see like a clear negative relationship between the two, which is what you would expect exactly. Now, the relationship isn't linear, right? You have a convexity in this the relationship. But this is not surprising, because on the one hand, the price flexibility of Cavalier and Engel is really measuring the instantaneous response of inflation, whereas the measure of Alvarez et al. Is looking at the accumulated output response. So to make the two measure, I mean, square one with another, we've simulated cumulated inflation response within the Cavalier and Engel framework. So we do that by essentially looking at what would be the accumulated inflation response over 12 months of a one-off shift in the price gap distribution. And if you do that, you can see that the relationship between the two measures becomes even more clear.
You have 10 more minutes.
Okay, so you can trust the presence of this time variation. Here we have a division between the intensive and extensive margin, and you can see that the extensive margin turns out to be quite important. So state dependence in price setting is quite important, and it becomes even more important than the intensive margin towards the end of the sample. So we do some counterfactual to highlight how important is the extensive margin. And you can see that, for instance, the extensive margin is associated with higher volatility when we have the peak in inflation in the UK around and right after the Great Recession. And we also look at to what extent this variation in the hazard function, so the incentive that firm face when they're deciding to set prices, is important overall. In particular, we're looking at VAT event studies. A VAT change is a classic shift in the price gap distribution, right? All of the sudden, all firms, I mean, they're facing a higher sales tax. But we show that the model is is estimating essentially a very different hazard function associated with the VAT, so that the VAT event really acts as also as a coordination device for all firms to make price changes more likely. And indeed, it turns out when we do the decomposition, because we can do some counterfactual here. So for instance, if you're looking at what would be the contribution of the shift in the hazard function, well, that is essentially contributing to most of the observed variation in inflation. Now, let me say something on whether this is not important for inflation dynamics. So we can use the model, the Caballero and Engel framework, to simulate, how quickly, a shift in the price gap distribution, say, a persistent change in the marginal cost, how quickly is that reflected into inflation? And we do that. So here the shock that we're feeding into the framework, right, with the black line, and with the thicker line, we have the response of inflation, starting from a low flexibility regime, year 2015, or a high flexibility regime. You can see that the model tells you that when there is low flexibility, the shock is much more persistent. The half-life of the shock is twice as large as what you observe into high flexibility. So to see whether that is also observed in the data, we estimate a generic time series process for inflation. But we're making essentially the persistence and the variability of inflation to be state dependent. So we're making it a function of whether prices are flexible or not at the aggregate level. And we do observe that in periods of high flexibility, high frequency inflation is more volatile. And if one looks at the persistence to a generic inflationary shock, you do get that in periods of low flexibility, also in the data, inflation is much more persistent. Here you have the impulse response to a 1% shock in the low flexibility in the high flexibility. As a reference in black, you have what you would be estimating with the linear model. So why is this reference to the linear relevant? Well, it is relevant because it tells us that if someone is missing this non-linearity associated with the flexibility, this person would be essentially missing out on the fact that at medium horizon, in period of high flexibility, the shocks would be faster to be absorbed. So this is essentially something that we can test, and we do test in the data by looking at the forecasts that are made both by the Bank of England and by professional forecasts. So if these experts, they're not considering the fact that in periods of high flexibility, the absorption of the shock, that there is a much quicker mean reversion to the shocks, we would expect to see that they're making larger forecast errors in periods of high flexibility. So to test that, we run a simple regression where on the left-hand side, we put the forecast errors, and on the right-hand side, we're putting a nonlinear function of the regime. It's important to allow for this nonlinearity because we do expect essentially that when you are in a low flexibility regime, right, there's no ability of the regime to explain the forecast error, whereas you do expect this variable to be relevant only in periods of high flexibility. And you also expect this nonlinearity to be more relevant at medium-term horizon forecast, because the differences, just to go back, right, they're larger here in the medium term, right, but they're not large at all, both at the short end and at the long end. And that's exactly what we observe, right? So it does seem that neither the Bank of England or the professional forecast will seem to incorporate this nonlinearity. The regime itself it turns out to be able to explain about a fifth of the overall variability of the forecast error, which is quite remarkable quantitatively. Okay, so just to summarize here, it seems that the Bank of England has generally underestimated the speed and the impact of shock, in particular in the periods of high flexibility that we observed between 2008 and 2011. And this point is potentially a failure of appreciating the fact that price flexibility was high, and in fact it was at its historical peak, and possibly that was a reflection of the fact that in the UK there have been VAT3 adjustment taking place right on that time frame. And conversely, the persistence of the low inflation that we've observed towards the end of our sample, it's something that can be understood also by looking at the fact that there was a low flexibility of price over that sample. And let me just conclude. What we're doing in this paper is to emphasize the importance of the time variation in price flexibility. We'll show that the price flexibility changes a lot over time, and in fact has fallen over the second part of our sample. State-dependent price setting plays a prominent role for understanding inflation dynamics, but most importantly, accounting for the time variation in price flexibility is something that is important for our understanding of inflation dynamics. Thank you.
Thank you, Ivan. And we'll move to the discussant, Richard Davis, please.
Thank you very much. I'll just share my screen. And do my slideshow. Okay, thank you so much for the invitation to take part. I found this a really interesting paper, and there were some fantastic discussions yesterday. I note some of them using UK data. I just want to discuss briefly the motivation for this paper. I feel it can be widened and broadened. I think it points to some really important things we're seeing. I'll then briefly discuss the setup and the contribution, and then lay out some comments and questions before just floating one final puzzle that I think the authors could think about. So on the motivation, the paper opens with this really nice statement from Janet Yellen, and clearly, as Ivan's made out, this is kind of key interest for central bankers. I don't need to tell this audience that. But two other motivations. First is the UK public. So since COVID, the COVID crisis, I've been spending half of my time running this thing. You can see the logo in the bottom, the Economics Observatory. And it's about trying to plug policymakers and academics into public questions. So we receive these questions direct from the public to our website. And I've just put a couple of them here. And you can see that there's real interest and concern in inflation and how it works. So will inflation take off, as some suggest? How can I provide pay increase to meet the cost of inflation? How can we plan for any of this? I thought these are really interesting. So I just think it's worth pointing out in motivating this paper that we live in a very interesting and extreme time in terms of expectations for inflation. And the more that we can do to understand that, the better. And then, so that's the sort of public interest. And then completely differently, I'm going to kind of propose or suggest that I think there's a potentially really important parallel in this paper with another kind of adjacent literature, which is that on firm level responsiveness and productivity. And that kind of widens out and makes even more important some of the approaches and findings here. So on the approach, the paper uses UK price microdata, as we've heard. It has 28 million or so monthly observations. I use this data, I'm so familiar with it, and it includes things like a detailed item description. It also includes the location of the item. And finally, it includes a shop identifier. So you can track the individual shop and you can create these price trajectories, which have been discussed. And I'm going to come back to some of those for sort of ideas of how the paper could potentially be strengthened in my comments. And then on tools, kind of analytical modeling tools, as Ivan set out, they use the generalized SS model, which I guess has its roots in the kind of inventory models that act sort of classic arrow paper. But the real motivation and the real, the strongest kind of grounding point in the literature for this paper is the Caballero and Engel paper, in particular the decomposition which allows you to disentangle the extensive margin and intensive margin. So that is the rise in flexibility, that is to do with the rise in the number of firms that are adjusting, and versus changes in flexibility to do with the size of the changes from firms that would have been adjusting anyway. And then, as we've heard, the authors use a regime switching model to then examine how their measure of flexibility maps into changes in how inflation behaves. The stylized facts, again, as we've heard, are that frequency and price adjustment is showing this interesting downward trend. We see that the thing I found most striking, price cuts seem to evaporate. And we have this negative co-movement of dispersion. So in the first order, or the rule of thumb, is firms are adjusting a lot less. And often when they do, they're making these bigger adjustments. Turning to the flexibility measure, as we've just seen in the charts, there's considerable time variation. It doubles between 2025 and 2010, then halves again. And that, using the decomposition, is explained by both the extensive and intensive margin. And the regime switching model shows this striking inverse relationship between volatility and persistence, and leads to these kind of important policy type conclusions. Coming on to those, as we've heard, neglecting this time variation potentially leads to, or explains forecast errors, is the finding. And the level is important. It's 22%. It seems that the private sector is doing slightly better than central banks. I'm not sure if that difference is significant, but it's 21% for the private sector. And then, really interestingly, there's this link with a big literature. We've heard about DeLocker and Eckhout. There's also the literature on superstar firms and so on how market power could be playing a role in reduced flexibility. Now, I think I may have had one previous iteration of Ivan's slide, and so I can skip through this a bit quickly, but I do want to make a couple of points in that he is now, and his co-authors have included sort of more detailed, it seems, analysis of VAT shocks. I didn't see that. So just briefly, the hazard function is clearly absolutely key, and it does look unusual in 2012. And they say it's most likely due to VAT. My view, that it can strengthen that, and can it be exploited? This is what they've done already. Just as a reminder, VAT in the UK is baked in, and it's important to contrast that in the US, in the sense that there's an immediate cost or benefit to firms if it's not passed in. It's included in the mark price, as opposed to in the US, where taxes are added at the till. And I think, so I was suggesting in this slide maybe to use it as an event study. I guess I'll now flip that and say I think that's hugely valuable. What we do need to remember, I mean, those of us that were working through that period, I was at the Bank of England through that period, is that the VAT announcements were very public. There was big political pressure on firms to pass them on. And so I wonder if that's probably a useful event study, but they are kind of quite unique, these things. In the slide on the left, you see a similar analysis from a recent paper of mine using the same data set, but just the much more recent data, looking at the COVID period. And it shows that when we had the VAT reduced rate for specific industries, those are the ones on the left, we saw a big spike in the number of price reductions and then price hikes afterwards, and which we didn't see in the parts of the economy that didn't receive the VAT reduced rate. So I think this area is very interesting. I think we do need to be careful that firms are under political pressure to pass these things on. And we should analyze them, but should we read too much into them? The paper establishes these shifts that are driven by the extensive intensive margin. And it's really interesting. And I wanted to encourage the authors just to see if they can dig a little bit more deeper and say something about the sources of this. And I note in the US, there's emerging evidence on how useful regional pricing data can be. So the Hazal et al. Paper I put there, that's all about Phillips curves, different topic. But the point is that in our microdata, we do have these regional dimensions. And the UK does provide a regional split. So I think the authors could potentially do this quite quickly. Would the results differ? My priors would be maybe you'd see regional impacts in 2008. Northern Ireland in particular gets a double hit from the south of Ireland that has its own banking crisis kind of a year earlier, and then the UK. And then are there differences in regions in market power? And again, on the left, I've just shown a quick chart from my recent paper that shows there's some tentative evidence of potentially regional differences in the micro data during the COVID-19 crisis. So could the regional data, the regional variable, be used by the authors? The key to the paper is price trajectories, and it's just worth flagging, I think, whenever using this data, just how different the pricing patterns are when you go by COICOP. So the charts on the left show the distribution of prices. This is just the simple level of prices. The colored area is the 10% to 90% deciles, and then it gets darker as you get towards the median. And I just wanted to flag how different these price patterns are. The US literature, Pete Clennell's sort of seminal 10 facts paper, shows, of course, that there are differences by types of good. But what I thought was interesting is that in some goods, and I draw Ivan's attention to lettuce on the bottom left, you definitely see these high frequency changes in foodstuffs that then seem to slow down. And so I wonder, again, another kind of disaggregation of their key finding is, could the authors look at the data aggregated to the industry level by using both the descriptions and the COICOP numbers, which they have. The data also offers a firm level identifier. Now, this is anonymized, but you can put it together to form a broad picture of the firm. So the charts on the left plot firm price changes, with the firms measured by the number of products on which prices are collected from that firm. And clearly, so if you're offering the ONS more data on your products, you're probably a bigger firm. And it is the case, and the authors reference this in their literature review, that there does seem to be a firm size effect. Could this, using their analysis, using their disaggregation, be used to track firms by type over time? So to identify who exactly is it that's becoming more sluggish, by which I mean which types of firm are responsible for this reduction in the frequency of price changes. And the motivation for my comments here, again, I realize this is kind of adjacent to their question, but I think there's a really interesting parallel. So again, the Arrow paper, which I believe is the sort of first SS type model, is all about inventory policy. And going back to the Caballero and Engel paper, which was a fun part of preparing these comments, at the end they have this really interesting conclusion, which is they say, look, there's nothing specific about prices in our results. Our whole framework is about lumpy firm level adjustment per se. And so what we have here is a kind of stepping back from the specific result is a more general result of a generally lower level of firm level adjustment. And I just note that, for example, in this Decker et al. Paper that looks at firms' responses to their own idiosyncratic productivity realization and asks, are we seeing kind of fewer shocks or are we seeing lower responsiveness? The answer there is declining responsiveness. And so there's quite a powerful parallel there, and maybe there's a common source. On the policy findings, just two comments and then I'll wrap up for the discussion. The first one is that, okay, so the finding is that 22% of the forecast error can be explained by this failure to include price flexibility. And the suggestion in the conclusion is central banks could use that to improve their inflation projections. A couple of comments. One, this is clearly very important, and an inflation forecast error, particularly in the UK model, for example, which is an inflation forecast targeting model, is a policy area per se. It means that you're going to be setting the wrong bank rate, and I think it would be worth clarifying that. So it's more it's more important when you are an inflation forecast targeter than just getting your forecast wrong, because you're using your policy tool to hit that forecast. If you're getting your forecast wrong, you're getting your bank rate is being set at the wrong level. And that the same is true for many, but not all central banks. That's a point worth making. And I agree that the Bank of England and others can certainly get hold of micro data quickly enough to include a measure of contemporaneous price flexibility in their models. But, and this is where I guess I'm sort of on the central bank side, we need to remember the transmission mechanism for monetary policy. So the tool you're using to hit that forecast that you're making is 18 months, 12 months at the shortest. And so my question for Ivan is, can they establish, or did they establish, have I made a mistake in my reading, whether contemporaneous flexibility measure has an impact at that horizon, or whether the contemporaneous flexibility measure can be forecast? So is it ex ante helpful? You've clearly established, ex post helpful, you've clearly established that. But is it also ex ante established? Can I today improve my forecasting based on your decomposition using the Caballero model? And then finally, in terms of the policy findings on or policy type suggestions on market power, again, we have the from other literature that the markup has increased in the post-recession period. And this is consistent and potentially explains this reduction in frequency of adjustment. Incredibly interesting, incredibly important if true. My take was I needed a bit more convincing. First reason is just a simple first order correlation thing, which is that if you look at the DeLocca or Jan Eckhout's recent book, these market power findings, also the superstar firms literature, are generally kind of secular, slow moving things. We've got this kind of wave of market power building up. But the flexibility measure does seem to move at a higher frequency, and there's that potentially problematic for this story kind of pick up in it post-Brexit. So I wondered if Ivan had some comments on that. And if not, I don't think it's a particular problem, but there's another potential to strengthen here, which is I think you could quite cheaply construct, for example, an industry level Herfindahl-Hirschman index, for example, to look at concentration by industry using the BSD. So that's the UK's firm level micro data on firms' revenues. And then potentially you could look at the explanatory power of concentration and how it changes when you're looking at industry level flexibility. So you'd have industry level concentration, industry level flexibility. Maybe that's for another paper, but it would certainly, I think, strengthen your story when it comes to market power. So overall, I think it's a well-motivated paper, but it can be really increase the motivation because it's so important. There's some great and careful data analysis where I think you can strengthen, and the policy implications are really important. The final thing I just wanted to float is a slight tension, or in a sense, a reason that this is kind of even more important and we need to get results even more, which is I think if we asked ourselves to think of our common sense prior of whether firms should be becoming more or less responsive. So for example, I've just said here, the rise in online shopping, digitization of prices and so on. I think we'd say that menu costs should be falling for many firms. That's my assertion. And thinking more thoroughly in this literature, I think our prior would be there should be some reduction in the inaction region in SS models. And so the share of prices in the inaction region should be falling over time, and we might see more movement. So more generally, there's this puzzle of why firms are becoming less responsive, which we also see in terms of firms becoming less responsive to their own productivity. So I think there's something really quite deep and interesting going on in this firm level data, and this paper makes a great contribution.
Thank you very much, Richard. Ivan, would you like to respond? And then we can take a few more minutes if there will be any other questions.
Yes, thank you. Can I perhaps go back to my slides to show something?
Yeah, I guess you can try.
Yeah. All right. So first of all, thanks a lot. This was a great discussion. A lot of food for thoughts for us. There is, I think there's quite a lot in the paper already, and you're giving us ideas of doing even more work, which is useful. Let me start from the end of your discussion, some of the more direct questions that you're asking us. So the first question that you asked in terms of the policy relevant of what we're finding is on whether the price flexibility is something that is useful in the way, say, the Bank of England approach their policy decision. And I think this is really what what we have in mind when we've done the last exercise. So empirically, well, suppose there's been a given inflationary shock to the economy, right? Empirically, what we show is that there are some periods where these shocks, right, that are mapping into inflation quicker than other periods, right? So in that sense, then you may think that I don't know, the reaction of the central bank may be not needed, right? If those shocks are more transitory, right? Than for instance, in other periods where the same shock would take a bit more time to feed through inflation, and therefore there may be a bit more of a need of a push in terms of aggregate demand from the central bank. So this is really the way we're thinking about this last part of the paper, and I agree with you, right? The bottom message of our paper is that, look, there are different way of measuring flexibility. Here is a way that the central bank could implement almost in real time. It does seem to contain information that the central bank is not looking at. Now, in these days, we're looking always a way of increasing the information set when we're deciding policy. This is an obvious area where we think, the Bank of England and the other professional forecast, they could do better. Then, in terms of the other point that you make, it's a much bigger point. What is driving, essentially this variation in price flexibility? Well, many things, right? So there can be together, both cyclical factor and secular factor playing a role, and their importance may be different in explaining different features of the data. And this is, I think this is something that is important to keep in mind, even in a framework, in a very plain vanilla SS type of model, right? You would expect that there is time variation in price flexibility, simply because of a shift in the price gap distribution. But these diverging trends are something that are extremely interesting. And that's something that I think, they've not been documented for other countries. And obviously, right, the relationship and the link with the literature on the markup is there. So I had prepared a slide which is not in the paper. So here I took the estimate of the Locker and Equid. These are done on UK data at one level. Now there's a difference between their estimates for the US and the UK. In the UK, the estimates of the markup that have been rather stable, right, up until essentially the Great Recession, where we've observed an increase in market power. So the timing with this increase in dispersion and fall in fall in frequency is it's really there in a way that for us when we looked at it, it was quite striking. So, and to go back to the very last point that you've mentioned, how we should think about these things going forward. Well, you're right? You would expect that the increasing importance of online shopping and so on and so forth may eventually reduce the menu cost. But at the same time, I think that if one is thinking about that, the market power, right, and the way, the sorts of decreasing costs associated with losing market share in general. There's something that are sort of like balancing the fall in the menu cost in the other direction. So which of these two forces is effectively prevailing in the aggregate, I guess is there to be understood. But I mean, it can well be the case that if we're all buying from a few providers, right? Although those providers may have like literally zero cost of changing their prices, right? Because they know that they're monopolists in some respect, right? They wouldn't feel the need of having to change their prices too often, right? To keep up with the shift in costs. And I guess I will stop it here and open to other questions if there are. But thanks a lot for your points. And you're right. I mean, like we could do better in terms of perhaps motivating the importance of our funding. And yes, I wanted to say something. There's more in the data in terms of heterogeneity, the regional dimension, sectoral dimension, and in fact, I mean, the division between like, you know, chains or shops, right? These are something that are quite relevant and they're like in our pipeline of hopefully future work in the area. Thanks again.
Thank you, Ivan. Any other questions? I wanted to ask or comment that if I understood right, actually you're trying to, when you were talking about the inflation forecast, you were talking about the flexibility and dispersion as explaining inflation, but I think maybe you did it and I didn't walk through, but actually flexibility and dispersion are endogenous to the inflation rate and maybe even more endogenous to inflation expectations. So did you address, you know, this issue? I think.
I mean, what we're saying is that they're important for the persistence of inflation after a shock, right? I mean, there being like a shock, I mean, like hitting inflation, like you would expect on average that the impact of the shock is to inflation is quicker, right? When you have high price flexibility. Why? Well, there is a higher pass-through of the shock to the overall inflation, simply because firms are you know, more keen and prone in changing prices. And you're totally right. I mean, like the time variation in price flexibility, it's endogenous. Like it will depend on the macroeconomic environment. It will depend on inflation expectation. And in fact, you would expect that in periods where inflation is more volatile, right? I mean, that there's going to be much more price flexibility overall. Our point in a way is a bit narrower. We know that, right?
Okay.
Do we incorporate this, I mean, like the implication of this when we're forming our inflation expectation? And in a way, it's quite surprising to find that we don't seem to fully incorporate that.
All right, thank you. Any other comments or questions? Okay, so thank you, Ivan. Thank you, Richard. And we can move on.
Thanks a lot.
Thank you. We can move on to our second paper on the session. Optimal policy under dollar pricing, and Dimitri Mukhin will be presenting. So please, Dimitri.
Thank you very much. So can I share my slides?
I think so, yes.
Okay, let me try to do that. Okay, can you see it?
Yep.
Perfect. Okay, thank you very much. Thanks a lot to organizers for putting our paper on the program, and thanks a lot to Vanya for agreeing to discuss the paper. So this is a joint project with Konstantin Yegorov from New Economic School, and the paper is indeed about the optimal policy under dollar pricing. And I guess I don't need to spend much time on the motivation, but just to remind everyone here. So the motivation really comes from this recent literature on the dominant currency paradigm. Right? There have been much attention to the dominance of the dollar in the international financial markets, and more recently to the dominance of the dollar in the international trade. International goods markets. And I think it's fair to say that the idea of this paradigm can be summarized with three key empirical observations. So the first one is that we know that most international prices are set in dollars, and actually this fact comes from early papers by Goldberg and Thiele, so it has been around for a while. So what more recent literature adds to that is that not only prices are set in dollars, but they are also sticky in dollars, right? So even though there are several commodities, there is oil, for example, which have prices set in dollars, but at the same time, these prices are pretty flexible, they adjust every day. There are also several categories of goods, manufactured goods, which have price durations similar to the CPI and PPI average durations, but the prices are set in dollars. And finally, the most recent papers, they show that this dominance of one currency leads to the asymmetric spillovers, asymmetric transmission of shocks between the US and the rest of the world. So in some sense, the US is insulated from shocks coming from other countries, while other countries are more sensitive to monetary policy of the US. And so while there has been an enormous progress in terms of documenting new facts, in terms of collecting new data, in terms of studying these positive implications of dominant currency, I think it's fair to say that we still don't know much about the normative implications, right? So what is the optimal policy in the presence of one dominant currency? And so that's the gap in the literature that we try to fill, something that we study in this project. So effectively, we make this assumption, right? We take the fact that most prices, international prices, are set in dollars, and then we kind of revise several classical questions in the open economy. So the first one and the most natural one is whether it is still optimal to have a free floating exchange rate, or maybe the dominance of the dollar generates incentives for countries to anchor their exchange rates to the dollar, right? So then, as I will show in a few minutes, we will see that because of the dollar pricing, the first best allocation cannot be implemented. And so there's still distortions present in the economy, even under the optimal monetary policy. And so the question is whether this leaves room for some additional instruments. So, and the natural one that comes to mind are macroprudential tools, such as capital controls. Then there's a question about the spillbacks, right? Whether the Fed should be concerned about the spillovers of its monetary policy. Can kind of the negative effects on the rest of the global economy backfire and affect the US consumers and producers? And finally, the final question is whether there are gains from cooperation, maybe at the global level between the US and the rest of the world, or more for some more local forms of cooperation between a subset of countries like a currency area. So clearly these questions are normative, right? Because we studied the optimal policy, but at the same time, there is a positive aspect here, right? We want to understand whether dollar pricing can rationalize the policies that we observe in the data, right? So in particular, we know that the vast majority of countries in the world don't have free floating exchange rate. They have something like a crawling peg or dirty float, and most often they use the dollar as an anchor currency. And the question is whether this can be due to the dominance of the dollar in international trade. Okay, so how do we make progress? Well, we start with the standard New Keynesian open economy model. So think of Galli-Monticelli model, which we augment with two key additional ingredients. The first one is naturally the currency of invoicing. So we will assume that all domestic prices are set in local currency, while international import and export prices are set and are sticky in dollars. So the second ingredient perhaps requires more explanation. So we allow for foreign intermediates in production. And it turns out that this is really important for some policy implications of the model. So why do we make this assumption? Well, first of all, we know that most internationally traded goods are intermediate goods, right? So by some estimates, intermediates account for about 70% of global trade. Moreover, we know that even if we look at the final goods that we buy in stores, foreign goods, so they usually have a very large local distribution margin, right? So before reaching the consumer, these imported goods, they go through the chain of transportation companies, wholesalers, retailers. And so in the end, only part of their final price is accounted by the import price, while there's also local distribution margin. And finally, combining these assumptions together, we can replicate the basic facts about the exchange rate pass-through, which we think are important for the optimal policy. So we have a very high pass-through, exchange rate pass-through at the border level, right? So at the border level, the price is sticky in dollars. And so once exchange rate depreciate, the price expressed in destination currency moves 1-to-1 with the exchange rate. But then once this imported good is mixed with local inputs and sold by retailers in the local currency, the pass-through goes down and can be actually close to zero, just like we see in the code. Okay, so these are the key ingredients which are important for the policy, but we try to keep our framework as general as possible in other dimensions to show the robustness of our policy. So in particular, we can allow for almost arbitrary asset markets. I will show you exactly the assumptions that we make, but we don't need complete markets. We don't need to focus on financial order. We can actually work with a fairly general structure of international asset markets. We can allow for any regular preferences and technologies. The nominal friction can be modeled as Calvo in the Calvo model, or as a Rosenberg friction, or as a menu cost. So again, the nature of nominal frictions is not really important for our results. And we allow for a rich set of shocks, including wealth shocks, productivity shocks, and preference shocks. Okay, so let me very briefly summarize our main findings. So the first one, and perhaps the main one, is that we find that that inflation targeting remains open for non-US economies, right? So even though as I will show you later, the allocation will be not first best, so the divine coincidence doesn't hold in this setup, it turns out that once expressed in terms of the optimal target, the monetary policy remains exactly the same as in a closed economy or in an open economy with producer currency pricing, right? So it's effectively the same policy that we have in Galli Monticelli or in Florida Galli Chiorte, even though it implements very different allocation. So then we look at the implementation of this policy, right? So what is the behavior of exchange rates, the interest rates, what is the allocation that arises under such policy? And here we find that the allocation looks very differently, and there will be something like a global monetary cycle. So even if exogenous shocks are not correlated across countries, because all countries respond to spillovers coming from the US, in equilibrium, there will be positive movement between monetary policy across the economies. So then, as I said, right, we study also whether there is room for macroprudential tools. And again, kind of surprisingly, we find that there is no case for capital controls. That really goes against the second best logic, right? So we usually think that if the allocation is not optimal under the optimal monetary policy, then giving the planner more instruments, allowing the planner to choose also capital controls should improve the allocation, but it turns out that's not the case, right? So in other words, capital controls can be very efficient in terms of fighting the pecuniary externalities, in terms of externalities coming from the financial markets, but they are really useless once we think about spillovers arising in the goods markets. And finally, I will show you that there's a kind of a fundamental conflict of interest between the US and the rest of the world. So, once there is coordination, the rest of the world wins from such coordination, but the US only loses. And so in practice, it would be pretty hard to sustain such agreement. Okay, so let me skip the literature review in the interest of time and go directly to the model. So as I mentioned before, we built on the Galli Monticelli framework. So there is a continuum of small open economies. We will assume that US is also a small open economy just to disentangle the new motives that arise from the dominance of the dollar in international trade. So in all other respects, the US is completely symmetric to all other countries in this model. In each country, there are two types of agents. There are households and firms. The household side of the economy is completely standard. So agents decide how much of locally produced goods and foreign goods to consume, how much labor to supply, and make portfolio decisions to share optimally the risk. And the interesting part comes from the production side, right? So we assume that there is constant returns to scale production function, which uses both labor and intermediate goods. And these intermediates, they can include local goods and imported goods. As a benchmark, we use Rosenberg price setting model with producer currency pricing in the domestic market and dollar currency pricing in exports. So as I mentioned before, right, we keep the structure of the model fairly general. So we want to show the robustness of the results, but we make two technical assumptions which give us a lot of tractability and actually allow us to derive the solution, the optimal policy in a closed form. So the first one is that we assume that there are optimal production subsidies to local firms and exporters, which eliminate monopolistic distortion in the local market and terms of trade externality in the foreign markets, right? So it's a fairly standard assumption in this literature. Usually people assume that there is just one instrument. We allow for two instruments, right? So they are specific to domestic firms and exporters, but at the same time, notice that these taxes, these subsidies, they are constant, they are state invariant, so they don't change with the shocks, right? And the second assumption is that we will assume that, and this is kind of the key assumption that we impose on the international asset markets, we will assume that the payoffs of assets are independent of monetary policy, right? So why do we make this assumption? Well, because we want to abstract from other motives for monetary policy, right? So we know that, for example, if country issues debt in local currency, then the monetary policy has incentives to depreciate its exchange rate, to devalue the currency, and to inflate away the debt, right? So there's a large literature which studies this effect, but we think they are completely orthogonal to dollar currency pricing, and so we exclude them from our analysis. So once we make these two assumptions, we can show that if prices were flexible, then the allocation would be efficient, right? So this gives us very important benchmark for our analysis. So the nominal frictions, the sticky prices, is really the only reason why allocation is not efficient in this economy, right? And when I say efficient, I mean from the perspective of one individual economy, because of course, from global perspective, there is incomplete risk sharing if asset markets are not complete. So more importantly, it turns out that this efficient allocation can be implemented even if prices are sticky, but if they're sticky in producer currency, right? So if firms set prices in their own currency, then monetary policy that stabilizes domestic inflation would achieve the first best allocation, right? And the intuition is pretty simple, right? So in each economy, there is one friction effectively, there is only one price that is sticky. And the monetary policy can take that price as a numeraire and adjust all other prices, which are flexible, to replicate the relative prices from the efficient allocation, right? And that helps to support the efficient allocation, right? So with one distortion per country, one monetary instrument per country, we can achieve the first best allocation and replicate the flexible price allocation. So that's the benchmark. This is right. This is well known. This is effectively Galliman-Acheli benchmark. So now what happens if we have dollar pricing in international trade? So let's start with non-US economy. And as I already mentioned before, it turns out that the optimal policy for these countries doesn't change. It is still optimal to focus on domestic margin to stabilize domestic price inflation, even though the resulting allocation is not efficient. So before I explain the intuition, let me just briefly mention the key properties of such policy, right? So the first one, and that's kind of the pleasant bonus of solving this model, it turns out that the policy can be summarized with this very simple sufficient statistic, right? We don't need to know the values of the parameters. We don't need to specify the source of nominal frictions, the asset market structure. We just need to look at one simple statistic that is potentially measurable in the data, right? And that's sufficient to implement the optimal policy. So then the second question is, what exactly is this price index, right? And if you take the model literally, then it is effectively the producer price index, right? It only includes the prices of domestic firms. But remember, I mentioned at the beginning that many imported goods, they look much more like intermediates, right? So before reaching the final consumer, they go through the chain of retailers and wholesalers, and then they are sold by local retailers. And so we show that the prices of such goods should be also included in this price index. Right? So what is relevant for this optimal monetary target is not the country where the goods are produced, but instead the currency in which the prices are set. So all prices which are sticky in local currency should be included into this price index. And finally, as usual, right, such policy is time consistent. So even if we assume that there is no commitment, even if we assume that if we solve for the discretionary policy, we would get exactly the same result. Okay, so let me now try to explain the intuition behind this result, right? Because it's really, at first glance, it looks really counterintuitive, right? It seems like in an open economy, there are two margins. There is, as usual, local production of local goods and local consumption of these goods. So this is local margin. And then there's external margin, right? So firms produce goods, they export them, then country exchanges these goods for foreign ones, and then households consume these foreign goods. This is what I call the external margin, right? And ideally, we would like to get the efficiency on both margins. We would like to close both the local wage and this external wage. And for PCP case, in the PCP case, we know that there's divine coincidence. The monetary policy can close these two wages simultaneously. So here, because domestic prices and export prices are set in different currencies, the monetary policy cannot achieve these two goals simultaneously. And the standard second best logic suggests that it should do something in between. It should kind of deviate from stabilizing local margin to improve this foreign margin, right? And what this proposition shows that that's not the case. It's optimal to focus exclusively on the domestic margin, on domestic prices, and can kind of completely give up on this external margin. So why is that? Okay, so let me start with the PCP case. In the PCP case, the monetary policy is super efficient because for any given export prices, which are sticking in producer currency, we can achieve any price in the currency of destination by moving the normal exchange rate, right? The planner doesn't need to pay any adjustment cost, but by moving the normal exchange rate, it can achieve any price abroad and generate any desired expenditure switch. With dollar currency pricing, this is no longer the case. The export price is sticky in dollars, right? And moving the normal exchange rate of this country will do nothing to generate expenditure switching abroad. And so the only way the monetary policy can change countries' exports is by somehow making exporters change their dollar price P star, right? And so what we can show is that it turns out that the decentralized export prices, the prices which are chosen by exporters in the decentralized equilibrium, they're constraint efficient. So even if the planner could choose both monetary policy and also these export prices, it would actually choose exactly the same export prices as private firms do, right? There is no externality in this sense. There is no additional power on the side of the planner. So the planner, as long as the planner has to pay the same adjustment costs as private firms, it would choose exactly the same export prices. And so as a result, there's nothing the planner can do to improve the allocation. And it turns out that this is not specific to Rothenberg model. It turns out that this is much more general property. It's true in the Calvo model. You don't need to assume CS demand. It's also true under Kimball demand. It's true if you have heterogeneous firms and more complicated input-output structure. And it turns out that even if you allow firms to choose optimally the currency of invoicing, that doesn't really change the results, right? So there's the Lucas critique doesn't really apply here. So in all these extensions of the model, we find that it's still true that the monetary policy focuses exclusively on the domestic market. Okay, let me now turn to the implementation of this policy, right? So at first glance, it might look as if this optimal policy is completely inward-looking because it just focuses on this PPI target. To stabilize producer prices, however, the monetary policy needs to stabilize the marginal costs of local producers, which depend on nominal wages and the price of intermediate goods. And it turns out that this opens the room for international spillovers, right? In fact, there are two channels for which US monetary policy disproportionately affects other economies. So the first one can be called the import channel. So think of US increasing interest rates, which leads to appreciation of the dollar and depreciation of other currencies. This means that import prices go up, right? Because import prices are sticky in dollars, so in the currency of destination, they go up. And that puts the upward pressure on marginal costs of local producers, right? Because they use imported intermediate goods in production. And so as a result, the marginal costs go up, and the monetary policy, the optimal monetary policy, which stabilizes PPI, it needs to tighten its stance and increase local interest rates. Right? So we see that the monetary policy in this case will move in the same direction as the US monetary policy. On the other hand, there's also export channel, right? So once dollar appreciates, it means that our export prices will also go up in the currency of destination. So demand for these goods will go down. So production in export sector will go down. And as long as there are some convexity in cost, it means that the marginal cost of local producers will go down, right? So in this case, to kind of counteract this fall in the production of the export sector, the monetary policy needs to ease its monetary policy and stimulate production in the local sector, right? So in this case, thank you. Thanks. So in this case, we get a negative movement between US monetary policy and the policy in other economies. Okay, so in either case, there is something like global monetary cycle. So even if shocks are completely orthogonal across countries, we see that they will co-move across economies endogenously in response to these spillovers. So there are also implications for the exchange rate, but this depends on the details of the model. And again, depending whether you have a stronger import channel or export channel, you can have fear of floating, you can have an anchoring of exchange rate to the dollar, or you can get a more floating, right, a more volatile exchange rate. Okay, and finally, this is, you can see that this discussion kind of parallels large literature about spillovers arising in the financial markets, this debate about the trilemma and dilemma, right? So it's to be more precise, what we find in our setting is that it is true that the trade-off faced by other countries is worse under DCP than under PCP, right? So in that sense, the trilemma doesn't hold, but at the same time, it doesn't mean that the fixed exchange rates are optimal, right? You still want to use this margin of adjustment, so exchange rate might be less volatile than under PCP, but you still want to adjust your exchange rates to insulate against US spillovers. Okay, so this is all I want to say about non-US monetary policy. Now, what about additional fiscal instruments, right? So in particular, can capital controls help with international spillovers? There's this view that complementing monetary policy with capital controls allows planners to kind of stabilize local demand, but also fight spillovers coming from other countries. And the most relevant paper for our analysis is the paper by Farr and Fernick, which shows that generically, if monetary policy doesn't achieve the first best allocation, then it is always optimal to have capital controls, right? There's aggregate demand externality, private agents make wrong decisions about saving and borrowing. And so in this case, the government intervention in the financial markets is desirable. So surprisingly, we'll find that that's not the case in our setup. So it turns out that once we have the monetary policy which stabilizes domestic prices, domestic demand, the capital controls are completely useless and they are not used by the planner. And so let me, given that I don't have much time, let me not show you the formula, but instead explain the basic intuition. So the key observation here is that the inefficiency comes not from the suboptimal local demand. Right? The inefficiency comes from the fact that the country doesn't export enough. It has suboptimal export prices, and as a result, it doesn't sell enough, or maybe sells too much in the foreign markets, but capital controls can't help with that, right? Redistributing demand or decreasing demand in the local market will not stimulate exports of the economy. So under the non-cooperative policy, the small economy cannot use capital controls to stimulate its exports, right? On the other hand, so as I mentioned before, this means that capital controls are not really a panacea against all kinds of spillovers. They can be efficient in terms of fighting pecuniary externality, but they don't really help with these inefficiencies coming from goods markets. At the same time, and that's important to keep in mind, if we think about the optimal policy from the perspective of the IMF, some global planner, it is true that we want to use capital controls, right? So if we see that output is inefficiently low in Brazil, it can be due only to inefficient exports of Brazil, let's say inefficient exports to Argentina. And so what the global planner would like to do is to redistribute demand towards Argentina, right? So that Argentina increases its imports from Brazil. And so from this global perspective, capital controls might be efficient. Okay, so let me skip this and spend my last, I guess, 6 minutes to talk about the US monetary policy and cooperation, right? So it turns out that once we solve for the US monetary policy, things get more complicated. You don't get such simple target. We're actually revising our paper now, and I think we will have stronger results soon, but actually the intuition remains exactly the same. So let me show you this simple case with fully sticky prices and complete asset markets. So it turns out that in this case, US optimal monetary policy has 3 main motives. So just like for non-US economies, it still wants to stabilize local demand. There's still price targeting. But on top of that, there are two additional motives. So first of all, there is terms of trade manipulation motive, right? So because US monetary policy affects the export prices set by all countries in the world, right? It means that US can actually lower its import prices by committing to a particular monetary policy. So that's this second motive. In addition to that, there's also dynamic terms of trade manipulation motive, which, so this is the terminology used by Costino, Lorenzo, and Ferning. So the idea is pretty simple, right? They show that if you are a large economy, then you can affect consumption in foreign economy. And by that, you can affect the global stochastic discount factor. And so you can affect the internationally traded asset prices. And what the large economy would like to do optimally is to decrease interest rates in the states of the world in which this country borrows and increase interest rates in the states of the world in which the country saves, right? So even though the US is a small open economy in our setting, its monetary policy affects global outcomes. It affects global consumption, it affects global stochastic discount factor, it affects global asset prices, and so it has exactly the same motive. So we kind of show formally that in the states of the world in which US borrows, it will overstimulate the global economy to bring down the interest rates to make this borrowing cheaper. So another closely related question is whether these additional motives, this additional power of US monetary policy, whether it increases the welfare of the US, right? Whether the US benefits from the dominant status of its currency, and whether China has incentives to promote the status of yuan at the global stage. It turns out that the answer is very ambiguous, right? It turns out that if you study the general model, the US can benefit or it can lose from DCP. So it really depends on the values of the parameters. If we consider super special case, which has been the focus of most previous literature, if we make asset markets complete, assume low linear preferences, etc., we can show that US benefits from DCP. But I would say that this is too special, you know, to extrapolate. I would say that I personally prefer this general result, even though it is more ambiguous. It seems like there is no reason to believe that generically the provider of the dominant currency necessarily benefits from DCP. Okay, and finally, this is the last result. So we solve also for the optimal cooperative policy, right? So once all these non-US economies and the US economies, they coordinate their monetary policy. So what is the optimal targets? And here, interestingly, we find that non-US monetary policy doesn't really change. So it is still optimal for non-US economies to target their domestic prices, but the optimal policy for the US does change. So instead of targeting local prices, exploiting these terms of trade externality, it turns out that US will stabilize global dollar demand, right? So this is, it looks maybe complicated, but effectively this is the demand for imported goods across all economies, right? It will stabilize this global trade in some sense. And so from this result, you can see that non-US economies, they benefit clearly because US now internalizes the spillovers on other economies, but the US doesn't benefit anything from this coordination because non-US policy didn't change, right? So the US has changed its policy, but it gets nothing in return, and so it has no incentives to participate in such coordination. So in a very special case, when there is a global recession, when the shocks are perfectly correlated across economies, in this case, the interests of all countries are aligned and you can get the first best allocation. But in all other cases, if shocks are idiosyncratic across countries, we get a fundamental conflict of interests and the first best allocation cannot be sustained. So one other implication that we discuss in the paper is that an alternative form of coordination can be a currency union. So it can be the case that forming a currency area at the local level without the US participating in such cooperation can be still beneficial for its members because they will partially internalize these spillovers in international trade, right? So if you know that the other country is not exporting enough goods, you can increase your imports of those goods. And so this internalizing these externalities will increase the welfare of members of this currency group. Okay, so let me conclude by saying that we solve for the optimal policy in the US and non-US economies, we find that inflation targeting is surprisingly still optimal for non-US economies, while for the US there are additional motives. And we show that while capital controls are inefficient, in this case, some local forms of cooperation can at least partially solve this spillover effects. Thank you very much.
Thank you very much, Dimitri. We'll move on to the discussant, which is Vanya Stavrakeva. So if you can upload your presentation. Great, thank you.
Can you see the screen? Okay, great. So thank you so much for inviting me to discuss the paper by Dimitri and Konstantin. I must admit, I probably need to read it another couple of times to absorb all the nuances of the paper. As you guys probably saw, it's an extremely rich paper with a lot of very interesting theoretical results. So let me start by just giving you a list, which is not essentially a complete list of all the interesting policy questions that this paper addresses. So Dimitri did a fantastic job in terms of presenting the model and the intuition from the model, but let me say it a little bit more to you, so to speak. So some of the questions that this paper addresses are the following. So is inflation targeting still the optimal policy for small open economies where lower pricing on exports and imports is prevalent? Should non-US monetary policy optimally respond to US monetary policy? Should non-US economies optimally peg against the US dollar? How does US monetary policy spill over to the rest of the world via trade and asset price valuation? To what extent should the Fed optimally incorporate the global spillovers of its policy in the way it conducts monetary policy? As you saw from Dimitri's presentation, there is even more questions than this. As you can imagine, each one of these questions can be a paper. So the authors have essentially included all of these questions in the same paper. So that's both very ambitious and essentially I'm applauding that, but also you need to maybe restructure the paper a little bit to make it easier to absorb for the reader. So Dimitri is humble, so he didn't mention that the paper is already RNR at the AER. So as a paper that's already RNR at AER, you can imagine it's already a very nice paper. So the way my discussion will be structured is I will give you a few essentially more slides on intuition from the model, essentially how I read the model and how I understood the model. And then I will give you more kind of unanswered questions. So kind of future work, big picture questions that I would like the authors to potentially work on the future. And I believe they are important for policy purposes. So I think it's useful to discuss them. So before I do that, let me tell you that it's an extremely detailed and very insightful paper with a lot of robustness checks. So it's a very ambitious paper and it's a must read if anyone is interested in the topic. Okay, so let's begin. So what are some of the key model ingredients and assumptions? So sticky prices, of course, is super important in monopolistic competitions. So here we have also differential pricing of the same good if sold locally and if exported. And moreover, the local goods prices are indexed in local currency and export prices are indexed in dollars. So of course, this assumption, here there's a caveat that the predictions from the model are most relevant for countries with a large fraction of dollar indexed imports and exports. So would the UK and the Eurozone be the best candidate if you, for example, want to take this model and actually test it empirically, which is one suggestion I would give for future work for the authors or anyone else interested in the topics. There are a lot of cool testable implications coming out of this model. So it's important to keep in mind what are the set of countries that it refers to. So then, as Dimitri correctly said, there are H number of assets, so it's pretty general in terms of what type of completeness or incompleteness you can have on the asset side. However, there is no financial sector, no financial friction. So that's important to emphasize. I think it became clear from Dimitri's presentation that the focus is on price stickiness and the real side. And the non-US economy are assumed to be small, taking all prices as given. So here we're talking about small open economies. So not only a lot of essentially dollar indexing, but also small open economies. Right. So now externalities, I would love for the authors to have like in one place all the externalities and a little bit of discussion around them. So for example, of course, the monopolistic competition externality is present in the paper. And then they discuss that it's addressed by introducing a subsidy. Then there is the terms of trade externality, which essentially the authors explain as the government sets export prices of domestic, the government sets export prices of domestic goods above domestic prices to exploit the monopoly with respect to foreign country. And this is addressed by introducing subsidies as well. So both the first 2 points are now presented as assumption 1, right? So technically, I would like to see a setup of the constraint central planner for the small open economy. This is what they can choose, and then let's decentralize it. Let's allow for effectively subsidies, these 2 types of subsidies. Let's allow for, the general monetary policy rule or inflation targeting. Now, so for example, it's pretty clear that the solution of this problem would be such that you want to impose the first type of subsidies that are addressing the monopolistic competition internally, but in terms of trade externality, when you're solving the problem of the constraint central plan of the small open economy, would you want to impose that? So that's my priority is no, right? So that will introduce some clarity in your choices here. Then the focus of the paper is the suboptimal price dispersion due to sticky prices. So this is the key focus of the paper. And they essentially here prove that the producer price index inflation targeting is the optimal policy. So effectively you're stabilizing the marginal cost of production. So domestic demand ends up being optimal while foreign demand isn't optimal under the optimal monetary policy. So it's second best allocation, unlike on the producer currency prices. And what's very nice about the paper is that they do a lot of robustness checks that Dimitri went over. So it's actually quite persuasive, this part. And then finally, there is discussion about demand externalities, which are also present in the paper, similarly to the paper by Farhi and Burning. And here they argue that the moment you introduce this optimal PPI inflation targeting, then you don't need any more the capital essentially account controls, which is a result of the paper. But again, my suggestion is start with the constraint central panel, show, okay, this is what we need to decentralize it. It will be just more natural in this type of literature. Right, so the global monetary policy cycle, which is another very interesting part of the paper. So the spillover of US monetary policy to the rest of the world is via the movement of the US dollar, which in turn affects the local currency price of imported intermediate goods and foreign demand for exported local goods, right? So here it's all about the real side. And then they prove that, some form of optimal pegging by small open economies is present, not full peg, but to an extent, some pegging is optimal. So what is the intuition? Assume that the monetary response to foreign shocks is only due to the presence of imported intermediates and that the currency appreciates in response to monetary policy tightening. Non-US economies will have a partial peg to the dollar. So why is that the case? So in response to the US monetary policy tightening, then the local monetary policy raises interest rates, which partially offsets the depreciation of the local currency and smooths movements in the bilateral exchange rate against the dollar. So it's going to prevent the marginal cost from increasing due to the increase in the local currency value of imported goods, right? So this is the important channel, and that's why these effectively imported goods are so important. So it is closer to realities. Indeed, many countries effectively peg to the dollar, and non-US monetary policy responds very strongly to US monetary policy. So we have a lot of evidence of that. Now, my first comment is kind of about the dilemma versus trilemma. So there is a part of the paper that has this, essentially I took this from the paper. So they say the following: just as in our model, the trade-off facing the policymakers in non-US economy is worsened by US spillovers, the free-floating exchange rate does not fully insulate from negative foreign shocks and does not allow countries to achieve the efficient allocation, transforming the trilemma into dilemma. So this is absolutely correct. But the original paper by Helen Ray on the dilemma or trilemma wasn't about that. So let me just speak a little bit about it. So here I'm going to go into discussing a little bit more about the financial side and what are the spillovers of US monetary policy when you introduce more interesting financial side. So the original idea is that due to UIP violation in particular for countries where the forward premium puzzle is strong enough. So what is the forward premium puzzle? You are increasing your interest rate, let's say, relative to the US, and your currency actually ends up appreciating in the future rather than depreciating. So what's happening here is that if the US lowers its interest rates, then you're going to see a lot of inflows in emerging markets with high interest rates, essentially, and then this is going to lead to overheating in the local economies of those emerging markets, high inflationary pressure, and the need to raise local rates even higher, right? So this is kind of the story. So take Brazil from 2008 to 2011, right? So we hit the zero lower bounds in advanced economies. A lot of emerging markets like Turkey, Brazil, India, etc., complained about this overheating due to significant inflows. Now, an important component here is, of course, the UIP violation. So the reason why the trilemma doesn't hold is because UIP holds. Right? So otherwise you will not be observing this type of inflows in those countries. So the inflows are intermediated usually by local banks, and often these episodes are associated with inefficient credit booms, right? So if one wants to really capture that in a model, we need a story where first you need to model the UAP deviation, and then you need financial intermediation with some form of frictions. Moreover, even you might need to introduce from fire to get the inefficient credit boom phase. So for those of you working on those models, you know it's very hard to get inefficient credit boom phases usually. So I would just advise you at the very least to provide a bit more discussion. So you definitely acknowledge the presence of this alternative story coming from the financial sector, but actually a small section kind of giving an alternative narrative of what is another channel through which US monetary policy transmits to emerging markets or small open economies, and what are the main issues there would be interesting, and how essentially the implications for optimal monetary policy might diverge. In addition, of course, to the capital controls. So here the main prediction is that you need actually capital controls. So that's my suggestion regarding the dilemma trilemma. I just want to point out here, given that there are so many policymakers, for me, a very interesting unanswered question is, what drives the cross-country heterogeneity in the strength and the size of the forward premium puzzle? And of course, not just cross-country, but over time, right? So this dilemma, of course, is particularly important and harmful for small open economies in emerging markets when the forward premium puzzle is strong, because the closer you are to UAP holding, the less likely you are to essentially give up your monetary policy independence. We are missing the model that gives us that. We don't have yet, at least that's my personal opinion, someone who works on exchange rates, that we still don't have the right theoretical model that really gives us what is the right cross-country and over time heterogeneity regarding the strength of the forward premium puzzle. Just want to mention it on this slide. And then my last comment actually is that you don't mention another story related to the financial sector, which I think kind of is related a little bit in the what optimal policy you're going to get out of it to your real side story. And this is the currency mismatch story, right? So effectively in your model, it's all about non-US economies indexing imports and exports in dollars. But of course, we know that a lot of countries borrow in dollars, and often you have currency mismatch. So how does the currency mismatch play a role into the optimal monetary policy? So here is essentially the alternative story. So it can generate a very similar correlation in monetary policy across countries. And how would it do it? So countries that have a lot of dollar import-export goods actually pricing tend to have currency mismatch. Those are also countries that tend to borrow a lot in dollars. So in the data, if someone goes to test your theory, those two theories will be compounded effectively. So essentially, they tend to borrow in dollars primarily and have assets in local currency. So often when the US increases rates, optimally these countries might have to increase rates in order to ameliorate the depreciation of their local currencies to prevent costly default of banks and corporates, right? So you might, often the narratives that you see from policymakers is, why were you forced to kind of, increase your interest rate in response to, let's say, the US increasing interest rates? Well, because I'm worried about the indebtedness, the dollar indebtedness of, the financial sector, of the corporate sector. I think it would be interesting at the very least to maybe try to combine, I mean, this is a very different model, right? I completely understand you have a very complicated model already, but for future work, because when one wants to go and test your model in the data, which I think is the next step for your research agenda, probably this will be the most closely related competing story, that you need to control for in the data. And there might be interesting, essentially complementarities between the inefficiencies coming from this currency mismatch, associated with default in your story. So just for future work, which, of course, is a very long research agenda, I would suggest just that. But in conclusion, I think it's a super interesting paper. It's a step in the right direction. And just to reemphasize once again, the future work suggestions. So for policymakers, I believe it's a first order importance to understand how important is the trade channel that you model here versus the dilemma channel that Helen Ray originally proposed versus this currency mismatch channel for the observed US monetary spillovers onto non-US economies. It's kind of empirically important to understand, okay, what is actually first order importance, if we have to set policies. So while macro pro regulations, in this paper are not needed, as only the trade channel is present, probably there'll be a first order importance for the other two financial channels. And moreover, there might be interesting interactions between the trade channel and the other financial channels. So it might be interesting to study them jointly. So congratulations on a great paper. And I think I need to read it probably 2 more times to absorb it fully, but I'm glad that I had the opportunity to discuss it here. So thanks.
Thank you so much, Vanya. Before I let Dimitri respond, we do have one question from Michelle, who's here. So Michelle, do you want to ask your question?
Yes, do you hear me?
Yes.
Okay, So Dimitri, my question is, the result about optimal non-US inflation targeting, if I understood correctly, it depends on having the US stabilizing the trade, the trade. My question is, in practice, what we have is an inflation targeting in the US. How far it is from an optimum as a second best policy?
Thank you, Michelle. Dimitri, do you want to respond to Michelle's question and to Vanya's discussion?
Sure. Okay, thank you so much. Thanks a lot, Vanya, for discussion. We're actually revising the paper right now, and so it's super helpful, super timely to get your feedback, and also, I can understand why you're saying that it's an intense paper. So it's, not an easy reading. Sorry about that. Okay, so all your points are very well taken, and so I already made some notes of how to accommodate them, but let me just respond to a couple of them. So one of them, you mentioned what happens if the planner can choose kind of simultaneously the monetary policy and also subsidies to domestic firms and exporters. So we just studied this question. So it turns out that if you don't impose that as an assumption, but instead allow the planner to choose optimally all three instruments, you get exactly the same result, right? So that's another way. It's exactly as you said. So you could restate that as a Ramsey problem with three instruments instead of making an assumption and then just solving for the optimal monetary policy. So I agree. That's something that we should probably emphasize more. So thanks a lot for kind of clarifying again the interpretation of Helen Ray's paper. I always found it super hard to understand, and it seems like different people have different things in mind when you say dilemma, right? That's one of the issues with this thing. But yes, clearly it has nothing to do with the original idea that this trade-off, this worsened trade-off comes from financial markets, right? And again, we should probably emphasize that even more, that we don't have any frictions in the asset markets except for some exogenously incomplete asset markets. So it's not about UIP deviations, it's purely about this goods market spillovers. And if you think of the dilemma as the situation where countries, right, just choose between two options, so that's I guess the way we wanted to think about it and discuss in the paper. But I agree we should clarify that more. So I agree also with you completely that it's a big, I think, empirical and also theoretical question. What are the interactions between the dominance of the dollar in the asset markets and the financial markets, right? So clearly it's not just a coincidence. There are probably some linkages. Maybe one drives the other, right? And probably there are some implications for the optimal monetary policy. So that's, I agree with you. That's something that would be very interesting to look into in the future. In terms of empirical evidence, I don't know, you know empirical literature much better than I do. The paper that we cite, we refer to, is the paper by Tony Zhang, right, who looks at the share of DCP in imports, consumption basket, and I think he controls for some measures of borrowing in foreign currency and finds that there is still evidence that spillovers are stronger for countries which have more DCP in imports and exports. But yes, I wouldn't be surprised that if you use some other control, some other measures of currency mismatch, you would get different results. So that's definitely is very challenging because of the linearity problem. Right, and so in terms of the last question that was asked about the US policy, so yeah, I mean, we actually are working on the quantitative version of the model now. We just want to put some numbers to see how large these effects are, and we haven't finished yet, but I'm pretty sure that the US monetary policy, optimal policy, will be approximated pretty closely by inflation targeting, right? Because all these additional effects, all these terms of trade, external, they are all proportional to the openness of the economy. And as long as the economy is relatively closed, I'm sure these motives will be pretty weak. So that's why, I don't want to overemphasize them, right? That's why we spent much more time on talking about non-US economies, which are more open, which have high share of DCP. And so for them, it's much more relevant, I think. Yeah, thank you.
Thank you. Any more questions from the audience? So maybe just a small questions or comment. You talked about a country's openness, and I was wondering whether you can reflect your thoughts about, people are talking about globalization, an increase or decrease in globalization? How does that fit into your thoughts? I mean, does your analysis become more important, more crucial? Is it real? I mean, how do you connect between, the real world developments of more globalization or maybe less, due to COVID and what we see and your theoretical analysis?
Sure. No, that's a great question. I think it's also close to what Vanya mentioned at some point in her discussion, right? That in some sense, so we know from the work by Carmen Reinhardt and Ken Rogoff that and Ethan Ilzetsky that most countries in the world today have something like a crawling peg. They have a dirty float, and they anchor their exchange rates to the dollar. And it's really amazing. By some estimates, you get higher share of pegs than under the Bretton Woods system, right? And I think one of the reasons comes precisely from this globalization, that as economies start trading more and more, that makes them much more interdependent. So these spillovers become much larger. And so one way to fight these spillovers is to use is to peg the exchange rate. And it might be and that moreover, the more open the economies become, the more it's kind of outside of our model, but it is what other models predict, is that it becomes more beneficial for countries to coordinate on the single currency, for firms to coordinate on a single currency, right? So the chances that we converge to the equilibrium where all exporters use dollar currency pricing increases, that strengthens the international spillovers from the US and makes it's even more appealing for countries to peg the exchange rates to the dollar. So I think there are a lot of complementarities, and the more open the economies are, the stronger these complementarities are. So in that sense, I think these are all very related things. And yeah, unless something, unless we have some drastic deglobalization, I think extrapolating this trend, I would expect to have even larger spillovers and having more incentive for small open economies to peg the exchange rates to the dollar.
Thank you. Any more comments from anyone in the Q&A or? Nope. Okay, so thank you all, presenters, discussants. We will adjourn for about 34-minute break and reconvene for the high-level policy panel on 4 o'clock Israel time. We hope to see you with us. So goodbye for now. Thank you all. Thank you.
everyone. It is my pleasure to virtually welcome you to participate at the Bank of Israel and the CPR's Inflation Conference and to take part in our policy panel. It's been 2 full days and we're finishing it with this policy panel. We have a distinguished panel which needs no introduction, so I'll be very brief, but I'll go alphabetical. Mr. Stefan Ingves, Governor of the Sveriges Riksbank and Chairman of the Executive Board. Mr. Ingves is also a member of the Board of Directors of the BIS and Chairman of the BIS. Governor Ingves serves as a member of the General Council of the ECB and the first Vice Chair of the European Systemic Risk Board, ESRB. Second, Mr. Thomas Jordan, Chairman of the Governing Board of the Swiss National Bank. In 2010, he was appointed Vice Chairman, and in 2012, Chairman of the Governing Board of the Swiss National Bank. Thomas Jordan represents Switzerland in the Plenary and Steering Committee of the Financial Stability Board, FSB. He's also chair of the FSB Standing Committee on Budget and Resources, as well as of the G10 Central Bank's Counterfeit Deterrence Group. Mr. Yuri Rusnok, Governor of the Czech National Bank. Prior to his announcement as governor, Mr. Rusnok served from 25 of June 2013 to the 29th of January 2014 as Prime Minister of the Czech Republic. Beginning of March 2014, he served as member of the CNB Bank Board and became governor in July 2016. Today, in the context of analyzing and evaluating the working of inflation targeting in Israel by the Bank of Israel, we are interested in learning about the experience in your country concerning this subject. Clearly, yesterday we had a keynote speaker from a big country. I would say we are, I'll use the word smaller open economies. The panel will begin with a short introduction from the governors, and then we'll proceed with questions from me to the panelists. The audience, and there's a large audience here virtually, you can post questions on the public chat, and if time permits, we will forward them through me to the governors. So we will go alphabetical. So I will we're probably going to go somewhere between 5 to 7 minutes with each governor. And after that, as I said, we will go to the question segment, and we will start with Governor Stefan Ingves. Stefan, please.
Thank you, and thank you for giving me the opportunity to participate in this very impressive conference on inflation targeting. In the beginning of the 1990s, monetary policy in many countries was kind of at a crossroads, and existing frameworks did not work well enough, and inflation tended to be too high. Now, up shows inflation targeting, and so far, this worked well for many years, but some 30 years later, monetary policy frameworks again seems to be at a crossroads. And that's because many of us have lately been struggling with too low inflation. Now, that raises, of course, the issue, why is that? Well, a couple of reflections. First, real interest rates have actually been trending down for 25 years and are at a historically low level. At the same time, expansionary monetary policy has become more difficult to execute because in many cases, policy rates have come close to the effective lower bound. Now, 30 years ago, the task was pretty clear: prevent too high inflation. Today, the debate is different, and at least when it comes to the public debate, people seems to be more interested in doing something completely different. So there's not so much debate about too low inflation as such. But given what monetary policy can do and cannot do, speaking for myself, I do think it's best for us to stick to our guns, which is basically price stability. At the same time, we're kind of at a crucial point, because if inflation stays too long for a long time, and inflation expectations as well, then that, of course, makes it very difficult to execute monetary policy in the future. And Governor, as you started out stating, we're talking here among a group of small open economies. And what that really tells us is that it's important here that the large economies, let's say the US and the Eurozone, actually can and will be able to meet their inflation targets. Because if that is not the case, it will make things also more difficult for us. Could I get the next slide, please? And one way of illustrating this, and this of course can be done in many different ways, is here the correlation between Swedish GDP growth and our trading partners, and also the correlation between the policy rate that we have and the policy rate of our trading partners. And here, as you can see, in a small open economy, the correlation between us and the rest of the world is actually very, very high. Now, what does that mean? It essentially means that if our trading partners enter into a recession, with a fairly high likelihood, we will enter into a recession as well. Now, of course, we can partly compensate for that, but it's not easy to completely 100% compensate for that, given the openness of the economy and what is going on in the rest of the world. Same thing happens, of course, when the international economy picks up, because then our exports are highly likely to go up and things will improve domestically as well. Now, with more synchronized cyclical patterns, that can be good or not so good, depending on what is going on in the rest of the world and how we actually do these things and how we handle monetary policy more sort of at the global level. It's possible still for a small open economy to keep the inflation rate close to target or closer to target, even if that's not the case in the major economies, but it's going to be quite hard to do. And having a flexible exchange rate certainly can help to some extent when it comes to dealing with that issue. But I do think that with a lot of international trade and completely free capital flows, it's much, much easier in small open economies if central banks succeed together, so to speak, compared to having a lot of divergence and trying to pull things off on our own. Thank you.
Thank you, Thank you, Stefan. This was great. And it kind of, you'll see later, it sort of hones in on some of the questions that I naturally will pose. We'll go next to Governor Thomas Jordan.
Amir, can you hear me?
Yes, we can.
See the slides as well?
Sure.
Okay.
They will upload the slides.
Is it okay?
Right. That's
Very
it.
good.
Now we see the slides.
Okay, perfect. Well, I would like to thank the Bank of Israel and especially Governor Yaron for inviting me to this conference. It's a great pleasure to be part of this panel together with my friends Amir, Jiri, and Stefan. Well, my remarks will focus on the Swiss National Bank's monetary policy strategy with particular reference to flexibility and credibility. Let me start with some remarks on the specification of inflation targets. Now, the law does not prescribe the SNB a specific inflation target. Our statutory mandate is more general, namely to ensure price stability while taking into account of economic developments. We define prices as stable when the inflation rate is less than 2%, but still positive. Our objective is thus to avoid deflation, but also persistent inflation above 2%. And our reactions to deviations from the range of price stability are basically symmetric. At the same time, our monetary policy framework allows for flexibility in our policy response. This flexibility is essential in view of two important characteristics of the Swiss economy. First, Switzerland is strongly exposed to shocks from the global economy. And second, the Swiss franc is a safe haven currency and tends to appreciate during crises. Now, given these strong external influences, it is important that the SNB is realistic about what it can and should achieve in the short term and what not. monetary policy should not attempt to fine-tune inflation. For that reason, we do not use a point target, but rather aim for inflation between 0 and 2%. Defining price stability as a range allows us to accept different inflation rates within this range, depending on the global trend of price developments. For example, we can accept prolonged periods of slightly lower inflation in an environment of increasing globalization and slightly higher inflation in an environment of shrinking global supply. Additional flexibility is provided by the fact that we focus on the medium term. Depending on the circumstances, we may tolerate short-term episodes of inflation below 0% or above 2%. This characteristic distinguishes our framework from pure inflation targeting. Thanks to this flexibility, we can assess the proportionality of our policy response in every situation. Now, this chart here shows two examples of such a situation in the past. Our conditional inflation forecast showed that the inflation overshoot in 2008 and the undershoot in 2020 would be temporary with unchanged policy rates. Whereas in 2008, no further policy action, especially no tightening, was necessary, the situation was quite different in 2020. Our analysis showed that inflation would only return to price stability if we could avoid an excessive appreciation of the Swiss franc. Because in order to maintain appropriate monetary conditions, we had to limit the appreciation by intervening heavily in the foreign exchange market. The forecast and its implication for our policy proved to be correct for both situations. These two episodes illustrate well how we use flexibility for a proportional policy response. Now, an important question is whether this flexibility harms our credibility. Some economists see precise inflation targets as the best way to establish credibility. We have not experienced a conflict between flexibility and credibility. The SNB has a high degree of credibility, both among market participants and the broader public. There's no confusion between a need for flexibility and possible arbitrariness. It is important to note that timely and effective communication is crucial for maintaining credibility while taking advantage of flexibility. Our conditional inflation forecast and our evaluation of the exchange rate situation are key elements in this communication. The SNB's credibility is reflected in particular by long-term inflation expectations. Go to the next slide. Well, these have remained well anchored despite the many episodes of crisis and safe haven appreciation and the associated temporary deviations from the range of price stability. Now, this chart compares actual inflation to longer-term inflation outlooks by professional forecasters. In the last 15 years, negative shocks have repeatedly caused inflation to fall below 0. By contrast, inflation expectation moved very little during this period. They remained at around 1%, reflecting the SNB's credibility. So, what does the current discussion about more symmetric objectives or higher inflation target mean for the SNB? Our monetary policy framework is already very flexible and it is also symmetric. Together with our high degree of credibility, it has served us well. In theory, high inflation targets may raise inflation expectation and nominal interest rates, thereby giving monetary policy more space to cut interest rates. Now, more policy space would mean less of a need for unconventional policy measures. However, I have certain doubts that the benefits of such an adjustment in Switzerland would outweigh the costs. First, it is unclear to what extent inflation expectations would align easily with the new target. The benefits might be lower than expected. Announcing a new target and then failing to reach it in a reasonable period of time would also damage credibility. Now, second, high inflation is costly. Swiss citizens would hardly see any benefits. On the contrary, they may protest that such a target conflicts with the spirit of the law. And third, unless the inflation target was increased by several percentage points, the gain in policy space would be relatively small. Under these circumstances, unconventional monetary policy measures would remain important. So let me conclude. Our monetary policy framework has given us the flexibility to deal with many external, mainly negative influences. At the same time, we have maintained a high degree of credibility with market participants and the broader public. Ensuring price stability has become harder with the decline in the equilibrium of real interest rates, as Stefan mentioned before, but changing the target does not seem to be the right solution for Switzerland. In order to fulfill our mandate of price stability, we will therefore continue to use unconventional monetary policy measures like the negative interest rate and foreign exchange market interventions where necessary. Thank you very much for the attention. Back to you, Amir.
Thomas, thank you very much. You put a whole bunch of things that I plan to come back to, such as symmetry, credibility, unconventional. So we will get to those, but you've laid out kind of the ground, and it's excellent. I want to go now to Governor Yuri Rusnak, and the floor is yours.
Thank you very much, Governor Yaron. It's my great privilege to be the part of this group. So thank you very much for invitation, and congratulations, Bank of Israel, and you organizing such an excellent conference. Let me be quite brief in this introductory remarks. I am representing the central bank in the really small open economy, which is definitely the youngest market economy amongst our group. Nevertheless, we are quite, please the next slide. We are quite experienced inflation targeter because we started already in 1998 with the inflation targeting. And I would say, and I can state very firmly that has worked well for us over last almost quarter of a century, including critical situations such as a financial crisis or this recent corona crisis. Inflation targeting framework has proven also in our case enough flexible, even for, let's say, transitory economy, which we definitely had been, and in some perspective we are still maybe catching up the more developed counterpart in European Union and elsewhere. So the inflation targeting frameworks prove to be able to serve also for this type of economy, and first of all to follow and fulfill our main target, our main goal, which is the price stability. I would say the inflation targeting never become irrelevant in our case, and never been seriously questioned. In the beginning phase or the first phase, so it means till the big crisis, till the financial crisis, the main purpose was achieving disinflation in transitory economy, which was quite successful. We belong to the low inflation country, and in our definitely in framework of our region in Central Eastern Europe. From 2010, we used to deliver mainly the stable inflation, so fulfill our main goal. The inflation target is set up on the 2%, but we use what we call tolerance band, which means a flexible band plus minus 1% around 2%. We has never considered raising inflation target. There was no need to do so. And of course, during the time, the framework has been refined technically and mainly communication-wise over all the period. According some of independent assessment today, our framework belongs to this most transparent and in the world. Please, next slide, or last one. I mentioned two crises. We have quite an interesting experience during these times. We are very open economy, as all of us in this panel. The export is something close to 90% of GDP. So we face quite a significant hit of the global financial crisis after 2010, and also because some internal, I would say, failures, we face some problems longer than many other counterparts till 2013. Part of this problem was also extremely low inflation at this time. So we decided at this time, or my predecessors in fact decided this time, to use exchange rate commitment. So in fact, the kind of interventions against the corona, they were basically that the goal was to not to let corona strengthen above certain level. And basically this unconventional tool means at this period of time, kind of switch off of inflation targeting, and the main instrument became the exchange rate commitment. The corona crisis, we've been in a bit, let's say, more comfortable situation, because just before the corona crisis came, we've been able at least partially normalize the interest rates. Our interest rates was 2.25. So we had enough space to maneuver with conventional tools. So interest rates, two weeks repo rate to decrease significantly. And we also use partially some macroprudential supervisory tools. Inflation during last 2 years fluctuated above inflation target. There was still some, I would say, consequences of overheated economy in a previous period of time. So we've been not forced to use any unconventional tools in this last crisis. And even we started with in the June, last June, so I mean 1 month ago, let's say the path back, hopefully back to the more normal interest rates. We started to increase the interest rates by first steps by the 0.25 basis points. So I will stop here, and I'm ready, of course, for a discussion.
Okay, thank you, Yuri. Thank you, Yuri. Let me start going through some questions to try to guide this thing. I would say we got, I think, both from Thomas and from Yuri, a very already kind of a statement that they feel very firmly in the current interest rate targeting. So Stefan, you were a little bit more, I would say, gave a longer perspective, and I want to ask, we've seen a lot of economies that had low and stable, low and relatively stable inflation, low interest rates, struggle to achieve higher inflation rates and inflation target in spite of central banks' commitment to try to attain this. Could it be that the inflation target policy framework is becoming less relevant? Should we reconsider it? If so, what are the alternatives? Is it just this AIT? Is that just the permutation that you see relevant? I would say to that, actually around the Corona crisis, some would say, look, many countries passed this recent crisis in spite of not having all the, or not utilizing, in fact, the interest rate tool that dramatically because it just wasn't there. And they conclude, well, should we be so worried about low inflation and low interest rate? So it's a loaded question, but I'll start with that and then we'll go on.
Well, yeah, it's a good, very, very good question. But I really do think that there is no need to sort of change dramatically. We can call it average inflation targeting. We can talk about a band in many different ways. But these are essentially just versions of the same theme, in the sense that it's hard to pin down inflation, let's say for the sake of the argument, exactly at 2%. So in some sense, regardless of whatever framework you have opted for, I think we're going to have to be satisfied with, in some sense, close enough. Because in a small open economy, it's just simply not possible to fine tune. And that sometimes actually creates tension, because given the media environment, there is always this idea that you can sort of fine tune things and get things to go exactly to 2% within a fairly short time period. And that's not really possible in the real world, because in our case, I think the average inflation rate for the past 20 years has been 1.5, which is clearly off target of 2%. While at the same time, 5-year inflation expectations have been fairly close to actually 2%. And in some sense, I think that reflects my view, which is saying kind of close enough. And then what we tend to forget, particularly when we talk about inflation targeting from a technical perspective, is that all central banks have various governance structures. And in the end, you have executive committees or executive boards or monetary policy boards consisting of a fairly large number of individuals. And you just can't turn decision-making among a group of individuals into sort of mathematical equations. In the end, compromises will have to be made among real people, and to stick to 2% in one form or the other. I think that's in some sense my way of thinking good enough for now.
Thank you. I'll go to Thomas or Yuri, if you have anything, if you want to kind of say a few more words about this, and then we'll continue. That's fine. So maybe Thomas, if that.
Well, thank you. I mean, well, I basically agree with everything Stefan just said. I think the differences are relatively small between the concepts we have in the US, in Europe, and in the small open economies. And of course, fine-tuning is something that is very difficult for small open economies. It's maybe one point that is, in my view, also important country for Switzerland. The range of having for price stability as a target, in a sense, was quite useful. And people usually are happy when inflation is within this range of price stability. It would be probably relatively difficult to explain that once inflation is above the target, that you have to compensate with a deflation and vice versa. So that usually brings, especially in small open economy, some volatility also for the business cycle. And that can be avoided with the concept that we have at this moment. So I think for especially the case for Switzerland, it is better to stick to the concept that we have, that we are happy when inflation is in a certain range, that we react forcefully when it's outside, always taking the situation into account. But it's rather more difficult than to compensate for past deviations especially when they have an impact then on the business cycle. So you create recessions or booms depending where you start. And so this is why I think the concept, and I'm speaking here only for Switzerland because every country is a little bit different, has some advantages.
Thank you, Thomas. Yuri, you want to?
Yes, a few words. I very much share what Stefan and Thomas just said. Our experience is, the credibility is key. Credibility of central bank to maintain very consequently that price stability is there. Absolutely agree that fine-tuning in small open economy is not possible, is an illusion. But I am sure that economic agents understand that very well. So in this respect, the inflation expectations are crucial, and the ability of central bank to keep these expectations, I would say, basically in the line more or less with what we mean by price stability. Target band has some let's say flexibility advantages on one side. On other side, of course, this is a bit vague interpretation. What does it mean? Price stability, for instance, in our case, when we are on the 3%, so on the upper band of this tolerance band, it's still price stability when we have 2% target, of course. That's on the other side, point target, it's better encourage inflation expectations, but it's practically almost never met in the point sense in our conditions, which we just said. So yes, I think what we try to do is following basically the symmetric reactions and keep as much as possible on the middle term that we are approaching as much as possible closely the target.
Thank you. All of you hit on some of the questions I had, which are, what are the advantages and disadvantages of a band versus a point? I think this tension between, especially for small open economy, that we are so much influenced from the outside between the fine tuning, and in that sense, the range allows a little bit more flexibility versus how much does it anchor precisely expectation, which in some sense, what Stefan had mentioned is the key. I'll start actually with Thomas asking you and Stefan, because you mentioned about medium term, which begins to sound like the ECB language and maybe in the background a little bit of the AIT now of the Fed. And the question is, does it not create on the one hand more uncertainty in some sense? I mean, it gives more flexibility of not hitting a target bang on, but what does the average person understands about medium? Even averages are sometimes harder, and so the question is, it's a question I laid out to John Williams yesterday as well. Does it at the end create more room to be sort of correct, but does it on the other hand create more ambiguity? And that also has to do with the question of symmetry, which it sounds very good, but in some sense, part of the whole issue of the ELB or ZLB stems from a fundamental asymmetry. So are we trying to create a symmetry around the point where it's not necessarily needs to be? So I'll start with you, Thomas, and then I'll go to Stefan on this.
Thank you, Amir. This is a very important question. And Well, we have the tradition of a medium-term monetary policy. That was already when we had monetary targets, and it's of course also since we have this in kind of inflation targeting or strategy for maintaining price stability. And it's really a little bit the history of a central bank that then gives the credibility what the public can expect from this medium term. And of course, every situation is a little bit different. And this is exactly the point that I mentioned in my introductory remarks. We need this flexibility because every situation is different. We make a kind of a cost-benefit analysis and then to find a proportional policy to bring inflation back into the territory of price stability. That had worked quite well so far. And sometimes we were above, sometimes we were below the target, but usually within a reasonable period of time, we were back, and it was never pre-specified. So it was not said it is a necessity to be back within 4 quarters or 6 quarters. We left that as on purpose open in order to evaluate the situation. If you look now at the last 15 years, we mainly had negative shocks. And the ammunition that we need, it was mainly to avoid deflation. So the big increase in the balance sheet of the Swiss National Bank is basically due to the fact that we had to fight deflation, or that inflation did come out of the negative territory back into the positive territory. So that was it's exactly the big challenge that we had over the last 10 years. But it is symmetrical. So we do not accept a prolonged period of a deviation. We try to bring inflation back, but we take into account the specific situation. Of course, as I said before, that the last 10 years were mainly a fight against negative inflation, against inflation being too low.
Thank you, Thomas. Stefan?
Well, we do have a 2% point target, but the fact of the matter is that if you look at what has happened over the past, let's say, roughly 25 years, then 75% of the observations when it comes to actual inflation is within a band of 1 to 3%. And that's to Governor Rusnok's comment that if you have a point target, you will rarely ever sharp reach that target. I mean, it lasts for a couple of weeks and then it's off again. So de facto, you sort of get up every morning and you aim at 2%, but that doesn't mean that you ever get there. And if you get there, it's sort of like the clock. It gets to 12 twice in 24 hours, and then you know that it's going to be off for the rest of the time. And then you live with that and try to deal with it as best as we can. But also going back to the 90s, when I was deputy governor here in the central bank, we made it very clear to the general public that we cannot fine tune, in the sense that if inflation is off, then we cannot get inflation to go back to target, let's say within 6 months or something like that. It will take a couple of years regardless of what you do. And then given that that's the case, many different things can happen in between. And that means that in some sense, you try to do as best as you can, but don't ever expect to get that precision to be there. And that, of course, brings us today into an environment where I think all the executive board members in the published minutes have said in one form or the other that given that inflation has been too low for a while, it's not a major issue if then there is an element of overshooting. We certainly can afford that, and that might even be a good thing, provided that that is needed, would be needed in order to keep inflation expectations anchored around 2%.
All right. Thank you, Yuri. I'll ask a slightly more technical issue about what do you target? Should you target things in terms of overall inflation, or should you target core inflation, excluding volatile components? We see in Israel, housing market, in many countries now, housing markets doing some things, and I'll get to that a bit later. But even conceptually, what should be looking for? And just going back to something Stefan had mentioned, and all of you did, about basically the inability to fine tune is also difficult even in large economies. The idea with small open economies were affected a lot by some of these. But going back to what Stefan said, given the globalization, so one is core inflation or not, and two, how important still is to leave the degrees of freedom of the small open economies versus essentially being in tune, completely synchronized in terms of the target of small open economies with major trading partners.
Yeah, it's I would say a few questions in one framework. Regarding the synchronization of the inflation target with trading partners, this wasn't an issue in our case, I would say, because we used to have, of course, a bit higher inflation than ECB, especially in this period of, let's say, late 90s, beginning of the century. So this was not an issue in our case. We've been appreciating in real and nominal terms at one moment, and it was a part of the general economic strategy. And it was not in any, I would say, conflict with inflation targeting in our case. As regards what we should target, we started with something like a core inflation in the beginning of our inflation targeting, which was basically the headline CPI minus what we call regulated prices. It means electricity or some other of these kind of prices like tobacco and something like. This was valid until 2005. Nevertheless, later on, we switched to CPI, so headline CPI general index, because the main reason for that was it was a bit difficult to explain to the broader public what does it mean, the core inflation or net inflation. So in order to be more understandable and let's say hope credible, we decided to switch to the CPI, which is much broader awareness and accepted. And therefore also, of course, it encouraging inflation expectation a bit better in this respect. Of course, it's true that this core inflation concept has some, maybe in some period, some kind of advantage that you do not need to use frequently kind of escape clauses. So if for instance, the oil prices are booming or in our case, sometimes there are periods of a bit sharper increase in food prices because some price changes in the international market, and we have to somehow time to time explain that this is something which we are not able to influence directly by our own monetary policy. So as in any cases, in all of cases, you know, this headline inflation has some advantages, but of course also some disadvantages. So that's maybe in this it's I would generally say that time and more it's important to be able to communicate properly what we are basically struggling in order to keep our mandate to keep the price and also financial stability in our case. It's getting be more and more important, the communication aspects of that.
Thank you, Yuri. I want to I'll let Stefan and Thomas in a second also following these questions, but I'll add one more layer since Yuri sort of talked about the difficulty of even communicating what are we trying to do. And I think now I mentioned the rise in prices in Israel. We've had low inflation, and yet the cost of living, when it goes up, and often there's a one-off price changes, as Yuri said, for this reason or not. There also there has been processes just because of government policies of changes on tariffs and just general globalizations that created a process in some sense of one-offs. One could think of that, and there's the issue of targeting inflation and separating it from this price, these various versions of price offs is sometimes difficult to explain, or why would you even aim at inflation? We've had low inflation. That was good because it is associated with this cost of living. And so in that context, maybe you can also talk about this core inflation, this synchronizing and communicating this idea that you want to have a target in spite of inflation, in spite of these other forces that might push prices as opposed to inflation. So maybe we'll start with Thomas and then we'll go to Stefan.
Well, thank you, Amir. Well, this is a very important question. Well, we have a medium-term approach. So in a way, you have always short-term adjustment of the price level that should then level off, and headline and core should converge finally. Of course, the level could be different, but at the end, inflation should converge. So our view is always that you need a look-through approach depending on what is driving short-term inflation. So for example, if you have an oil price shock, this is something like a supply shock, which has an impact on inflation in the short term, but not in the long term. But of course, the price level is affected, and that should not trigger a monetary policy reaction. So the medium-term strategy neutralizes a little bit that when you have an inflation forecast, and the longer end of the inflation forecast should also always be compatible with your inflation goal or target. The second point is, I believe, for maintaining confidence and trust with the citizens in general, it's important to have a inflation concept that includes all relevant components for the broad mass of the population. So especially including prices for housing, but also energy, etc. So you can have the short-term deviation, but nevertheless, this is what matters for the people, and you have to explain them what happens to this relevant price level. Maybe you have to explain while you have short-term deviations where inflation is above or below the target, but by excluding certain components, at least this is our experience, you get the risk that people do believe that the entire index is a little bit fabricated in order to say we are on track, but actually the living standards for people is impacted negatively. So we always opted for an option where we have really a CPI inflation that is relevant for many people. But of course, the short-term deviations, we accept them, do not compensate them directly with this monetary policy, but the medium-term outlook should always remain within the range of price stability.
Stefan?
Yeah, I very much agree with what Thomas just said, and I think what is important here is that you go for a broad, well-known index, whatever that means in different countries, so that the general public actually has heard what you're talking about. And there's a major risk if you take out this or that from time to time, because exactly as Thomas said, then that could raise the suspicion that somehow mysteriously are always tweaking the numbers. Now, what this of course means that when you calculate the CPI, it can have all sorts of difficulties and drawbacks, and it can be done in many different ways, but at least there's something there that is done by, in our case, by Statistics Sweden. So we don't do it ourselves. And it's a concept that has been around for more than 100 years. And that creates some stability to the thing. Now, when you do it that way, of course, then you end up having to explain exactly the way Thomas explained it, that once in a while you have transitory factors, and the most common transitory factor that we have to deal with is essentially energy prices. And sometimes you have to add energy prices and exchange rate movements happening more or less jointly. And then of course you have to say that this is temporary. And now, of course, given the COVID pandemic and all the strange things that have happened in that context, when you have had difficulties actually observing some prices at all, then that has created some issues of volatility. But then it's up to us, and it falls on us to be clear enough, saying that, well, you know, this is the CPI is going to jump around for the next year and a half or something like that, but eventually things will stabilize. And the short version of this is, whatever you have chosen, you have to stick to it for a long, long time, because it's a major investment to explain to the general public what you have chosen. And that takes decades actually before it sinks in. Thanks.
Thank you, Stefan. I'll connect a question with yesterday's discussion with John Williams. He basically referred to the QE as another tool that lowers the effective ZLB or ELB, and in that sense, essentially helps, or sense in that kind of supports helping in getting back to the inflation target. And we are here more of kind of more generally as a small open economy. And I think Thomas, in many ways, in his introductory comments, kind of pointed to these, but I just want to kind of ask more generally, how do you view, we talked about inflation targeting, and often we think about the interest rate tool, but more generally, how do you view these, or any unconventional tool, is it unconventional anymore, as useful or not towards these inflation targeting goals as part of our toolkit? So maybe I'll start reverse now, Stefan, Thomas, and then Yuri.
Well, if you think about what central banks have done, let's say for the past 100 years or so, it's always about the balance sheet of the central bank. It's always about the balance sheet of the central bank in one way or the other. You cannot move the policy rate without zero happening on the books of the central bank. That's just the way it is. Now, for the past 10 to 15 years or something like that, people tend to believe that it was enough to talk about the policy rate without using the balance sheet. And I think that that's just flatly wrong. Ideally, because eventually you have to put the money where your mouth is. And if people sort of figure out that it was just hot air, then you end up with a problem. If you have credibility, then you can move the policy rate a bit and markets adjust. But eventually you're going to have to put money where your mouth is. And that essentially means that you're going to have to do QE or focus on money supply or do whatnot, because either you're talking about the policy rate, you're talking about the asset side, or you're talking about the liability side of the balance sheet of the central bank. And pick two and you're going to get the third. That's just the reality of doing monetary policy. And one way or the other, you're actually once in a while going to have to expand your balance sheet massively. Because if you do that once every 30 years, then market participants will sort of think that, well, you know, these guys are actually ready to fight for what they want to achieve. And then people will adjust to that. Thanks.
Thank you, Stefan. Thomas?
Thank you. Well, I fully agree with Stefan's points. And of course, it would be nice just use the nominal interest rate, the policy rate to move around. We had a period, maybe the 90s and until the big financial crisis, where that was possible, even with relatively small changes in the balance sheet of the Swiss National Bank. But of course, that changed completely after 2007, 2008. And in a situation where the equilibrium real interest rate is very low, inflation is very low, you have no other possibility to use so-called unconventional monetary policy. For us, this is negative interest rates and especially extending the balance sheet, mainly by interventions or by buying other assets. Without that, I think the capability to steer inflation would be not here. So we have to use those instruments. In a way, we can call them unconventional because we didn't use them in that way exactly before. But as Stefan said, it's always about the balance sheet. So this is the liquidity that we are injecting in the economy has a big impact. And it has an impact even if you are at the zero or at the effective lower bound. It has an additional impact, and this is especially the power then of monetary policy. So as long as these equilibrium real interest rates remain low, the relatively minor adjustments of inflation targets will not bring us away, and we will probably have to continue for some time these unconventional, so-called unconventional monetary policy measures. Thank you.
Thank you, Thomas and Yuri.
Thank you, Amir. You know, it's very difficult to add something to what just my distinguished colleagues both said. I fully agree with them. We have also this experience, you know, we will always have to react on the situation in the society and economy. We are basically, our main goal is to moderate the fluctuation of the economic cycle, nothing more. And if situation is such that we have to use some instruments which we maybe call unconventional, but what just Thomas said, it's a question of notions. We have to do it, and the balance sheet is the crucial one what we have in disposal. We had this experience with the exchange rate interventions during this period 2013-2017, when we expanded our balance sheet by something like 100% or something even more, maybe, I don't know just exactly yet at the moment. So, that's something which we have to do it if the situation requires. Of course, once we are in the, I would say, comfortable situation, like for instance, just we have had, because the inflation is more or less vital, close to the target, and we can moderate slightly the situation, keeping on the horizon of monetary policy in the certain range close to our target. That's the comfortable situation, but this will probably be with us for a while, and it will disappear once again. We will have to definitely, we will be challenged by new situation. And I completely agree what my colleague said. The balance sheet is crucial, and the ability of central bank to act is crucial to keep our credibility, not only to talk. That's our experience, you know. Once you will talk, it's not enough at certain time.
I think we all agree credibility is key. Anchoring is a function of credibility, and they both need to be there. I want to ask, we had one question from the floor, I guess, whether, and any of the governors can if you wish. I don't know who the person is, but they ask whether there are discussion by central banks or what's your view on small open economies basically targeting nominal GDP targeting, okay, as a sort of an alternative? I think we sort of heard the views on the variation, but if somebody really quickly wants to say something in that regard, I'd be happy. I don't know, Stefan, if you want to say something on that. I don't want to put you on the spot.
I mean, I think it would be quite complicated. And it would be quite a sales project convincing the general public if everybody else in the rest of the world is doing something else. So whoever is trying, I wish them luck.
All right. Very pointedly, as Stefan can be very right on the money in many ways. I want to put one last question, which is more recent events. We talked a lot about, and I think, Stefan, you sort of threw in the answer of what I expect you to say, which is we all see in the U.S. inflation, CPI is quite high. There's a broad discussion. Is this temporary, or is this due to supply chain and maybe pent up demand, and this is just a very temporary thing, or is this a more prolonged thing? That's on the one side. On the other side, I've mentioned these technological evolutions that improvements that are essentially affecting prices. We've seen some evidence of flattening of the Phillips curves. So just kind of on, where do you really see this as a short run phenomena, the way you look at the data right now? And Yuri, maybe we'll start with you. We'll go Thomas, and we'll end with Stefan.
Thank you, Amir. I don't know. I must say, I'm not sure that it is only one of very transitory phenomena. Maybe, and hopefully yes, but there are also some signs that it could be something more structurally based. I mean, in developed world, we are facing definitely the significant demographic shift, which means that the potential workforce is shrinking. And it plays some role. We have here something what we can call it this greening of the economies, which is on one side, it's a structural change which is mostly forced by regulation, but it's of course linked also with the technological development. But in contrary to what we used to have as a technological development in the recent past, let's say this fantastic progress in telecom and electronics, which definitely contributed to slow down price movement, these new phenomena could increase the prices in some respect, because the energy sector, the automotive, and many others, chemistry in some respects. So I am not sure that these new phenomena is only because some, let's say, logistics problems, in fact, or changes in international chains. So I don't know. I have no answer. In fact,
Fair.
I would like to have it, but I have some doubt about this so strong, repeatedly mentioned transitory. The question is, what does it mean transitory? We have had some experience in our history, in our political history, that there was something which was temporary. For instance, the Soviet invasion after '68, and they said the Soviet troops will be in Czechoslovakia temporary. This temporary was 20 years, yes, or more than 20 years. So let's see. I don't know.
Thank you. Thomas.
Thank you. Well, this is, of course, probably the most important question that we have now in monetary policy. And well, our analysis at the moment also supports the view that this is temporary, given the data that we have. And at the same time, I think we have to be careful. We now profited, and very similar to the explanation by Jury, over a very long time by a series of positive supply shocks. So the globalization brought in new markets. They usually delivered consumption goods at lower prices. And that was not a one-time effect. It was an effect that came over many years. So consumer prices in the Western world were very low or even declined, given this fact. Now, maybe we are really at the point that may change. It could be towards a more greener economy, but also could be because of globalization cannot deepen further, or will be even taken back to some extent. So that could be something. And then, of course, an element that is also very closely to follow. For a very long time, it was almost impossible to increase prices. So neither trade unions asked for higher wages, nor did firms try to increase prices. That was not everywhere exactly the same, but in many relevant countries. And when suddenly there will be a shift where price increases are accepted more than in the past, and where trade unions try to increase wages more than in the past, that could then also change a little bit the dynamic. And suddenly we are again into a situation that we observed in the past, but not during the last maybe 10 to 15 years. So we have to observe that very closely. And of course, we hope that this is temporary, but if it's not, I think that will be the proof of the pudding, where the central banks really then are willing to maintain price stability over the medium term. Thank you.
Thank you, Thomas. Stefan?
Well, we see this as temporary when it comes to the inflation rate in the near future, but I agree with what my colleagues have said, because certainly in the medium to long run, technology will continue to matter. What happens in the global labor market, or does not happen in the global labor market, certainly will affect what happens on the wage side, and also when it comes to export and import prices. And then, of course, it took a long time before we realized that real rates were actually coming down, and real rates were coming down substantially, given given our mindset in the 90s. Now, it's highly unlikely that real rates will stay negative forever. So eventually real rates will go up as well. But when that happens and at what speed it will happen, too early to tell.
Okay, I think we're just at the end of in terms of the allotted time. I first of all want to thank really deeply for my esteemed colleagues, the governors. I consider them as friends. It's more than just esteemed colleagues, for really insightful, thoughtful, and practical. It's not. It's all packaged in one, and this was really great. And thank you so much for your time. Generally, this was I want to thank our research department and all the for putting and the CPR for a whole set of papers that sort of put this balance between academia, policy. I think it's very important. We learned a lot. I wish everybody, first of all, good health. And thank you again to all participants and all contributors. Thank you.
Thank you very much.
Thank you.
Bye.